This meeting to order.
Recording in progress.
Orders of the day. We have nothing. Hang on. We have nothing to wave sunshine on. We've shown to have excellent Zoom etiquette. So if you have a temporal question, go ahead. Feel free to interrupt the speaker or interrupt a fellow trustee. But if you have something of a more strategic matter, let's wait until the end of a presenter's presentation, and then we'll go round robin. We will always do votes round robin. I reached out to Harvey to see if we could do action by unanimous consent, but Harvey said, no, the rules that allow us to do Zoom are pretty restrictive or conscriptive. So we will always do round robin for votes. Members of the public, raise your hand. Linda will probably notice you have your hand up. You're welcome to jump in to ask questions. In fact, floor's open now if anybody from the public wants to say anything.
Mr. Chairman, would you kindly call the roll to start our meeting?
Thank you, Harvey. Yeah. All right, let's go around. Andrew.
Here.
On.
Here.
Great. Sunita.
Here.
Word.
Present.
Eshwar.
Here.
Dick.
Yes.
Franco.
Here.
Dave Wilson.
Here.
I'm Chair Lanzheimer. Thanks for reminding me, Harvey. Everybody's here. Public, any comments? If not, we'll move directly on to the consent calendar. Let me make a remark before I ask for the motion. You'll see that we've got a disability application that Dick and I and the panel denied. I'm asking for your consideration. It wasn't that we don't believe Officer Zanato. It's just that there wasn't enough evidence in the file. So to the extent that you may have read her file, if you think we missed something, it's probably worth pulling off the consent calendar. If not, I'll entertain a motion to approve the consent calendar.
So moved by Santos.
And a motion by Santos. Do I have a second?
Second, Wilson.
Okay, I got a motion by Santos, second by Wilson. Let's go around. Andrew.
Aye.
David.
Aye.
Sunita.
Aye.
Howard.
Yes.
Eshvar.
Aye.
Dick.
Yes.
Franco.
Aye.
Dave.
Aye.
I'm Chair Lanza, and I vote aye as well. Drew, all we have under investments is your oral update, so I'll just turn the floor over to you.
Okay, great. Thank you, Mr. Chairman. Yes, we don't have anything under investments, but I do want to share fiscal year-to-date performance estimates provided by Makita. And as always, just so the board knows, these are estimates and these are unaudited numbers. As of November 1st, the plan was down 1% fiscal year-to-date. The healthcare trust was down 2.5%. This, of course, does not include yesterday's steep sell-off. Yesterday, the market fell quite a bit after the Fed announced its 75 basis point hike. And last month when I gave you the performance estimates was down about 1.5% fiscal year to date. So we're probably around the same range if you include yesterday's sell-off.
Drew, just off the top of your head, can you sort of tell me roughly how far down this year is the 60-40 portfolio roughly?
I have to take a look, Drew, and if Laura is here, maybe she can jump in. I suspect that the 60-40 is down more. The bond markets have also taken a hit, and with the 60-40, with all the 60 being entirely in public equities, which is mark to mark daily, I suspect the 60-40 is down more.
Yeah, but thanks, Prabhu.
Yeah.
Hi, Chair Lanza and CIO Polani. This is Jared Pratt from Makita. I could just say that through the same time period, so through a couple days ago, a 60-40 portfolio year to date, calendar year to date, was down about 20%, 17 to 20%, depending on what's exactly the 60 and what's the 40. But an ACWI and global ag mix was down 20.7% calendar year to date.
Thanks so much, Jared. Well, trustees, let's give all of ourselves, Prabhu and staff, a big pat on the back. And Vince, I'll buy him a beer next time I see him. That strategy worked, didn't it, Prabhu?
And
yes,
so I'm sorry, I can add real quick. Since June 30th, so fiscal year to date, 60-40 was down 3.6%.
Yeah.
Excellent. Thanks, Jared. That's great.
So our portfolios outperformed the 60-40 by a good 200 basis points at least. But then again, that's also because, as I mentioned before, public assets are mark to market on a daily basis. But it certainly protected the portfolio, the fact that we are diversified. So moving on, I just also wanted to let the board know that on Tuesday, November 8th, I will be I'll be making the annual fee presentation to the City Council. This is the 5th year in a row that we've been doing this. The first 3 years that I was here, I presented the report with Trustee Sunzeri. And last year, Trustee Sunita Ganapati of your board was kind enough to accompany me. And next Tuesday, again, she will be presenting the report along with me to the City Council. And hopefully she will also do this for the next 4 years when she gets re-elected to the board. With that, Mr. Chairman, I will conclude. I'm happy to take any questions.
Floor is open. Anybody have any questions for Prabhu? Great. Hey, Bill, I see you and Ann are on. Hey, Bill, you've got item 3A and 4C. Why don't you put them together, Bill, and take them in any order you want to? Put them together, Bill, so you're all at once.
Okay, we'll start with 3A. Let me share my screen here. All right. Are you seeing my screen? Okay. So this item, we've got our preliminary pension valuation results. And then the next item, we're going to talk about OPEB assumptions. But in addition, for this item, last meeting, we deferred a decision on the pension economic assumptions. So we will review those assumptions as well in this presentation. And we'll be back in December with the final pension valuation and draft OPEB valuation. So to get us started, I'm going to turn it over to Ann Harper to run us through the preliminary results. You're on mute, Ann.
Good morning, everyone. Happy to be here and presenting some, I guess, a little lackluster results because they're almost identical to what we were showing in our estimates from the last board meeting. So as you recall from the last board meeting, we showed you estimates based on actual investment returns, but we had not updated the liability side of our valuation. And so these results include the updates to those liabilities. So here we're looking at the funded status on the left-hand side of the slide, and the bars represent the liabilities. The different colors represent the different status for the membership. And then the lines represent your assets. The green line is the market value of assets, and then the actual value of assets is that blue line. So on a market value basis, the funded status decreased from 87% to about 78%. But then on the actual value side, the funded status increased from 77% to about just under 80%. And if you see the space between the blue line and the top of those bars, that is your unfunded accrued liability on the actual value basis, which is the basis for how your contributions are calculated. So you can see that that UAL has decreased from last year to this year. There's the detail broken out on the right-hand side between tier 1 and tier 2. I'm not going to go over that. Just of note is that your tier 2 funded status has remained above 100%, both on the actual value and on the market value basis. Next, we're looking at the preliminary contributions. On the left-hand side, we have the total contribution rates, and the right-hand side are the total contribution amounts. So the contribution rate for the city has fallen from 81.5% to 76.9% from last year to this year. And the primary reason for that is the decrease in the UAL payment, which you can see are the yellow and the gold bars. And then the normal cost rate for the city has fallen just a little bit as well. And that's due to the shift from when the tier 1 members leave employment and then their tier 2 members are replacing them, and there's a lower cost for their benefits. So that's the primary reason for the drop there. And then the member rates are pretty much the same from last year to this year, just a slight uptick. And then the total contribution amounts for the city for fiscal year end 2023 to fiscal year end 2024, because that's when the contributions will actually be paid, fell from 212 million to 209 million. So as Prabhu was saying, we all know that there's been so much incredible volatility in the markets the last few years. And so we thought it would be helpful here to show you how that translates into your plan assets, specifically the actuarial value of assets, because there's so much going on here. So first, when you look at the left-hand side of this slide, what we're showing here is your actual versus expected investment earnings, okay, on the market value basis. Your actual investment earnings are shown by the green bars, and then what was expected based on the assumed rates of return are shown with the blue bars. And of course, the first 3 years are pretty stable, but then the last 2 years here, you can see the huge fluctuation between actual and expected earnings. And I do want to make a note, step back just a little bit from 2019 and 2020, because there's always this, sometimes there's this confusion when we say there's a loss on assets. It doesn't mean that you lost assets. It just means that your actual investment earnings were less than expected. So we did have actuarial losses in 2019 and 2020, even though the assets did have a positive return. It just wasn't as much as the expected return that we were assuming. So then if you turn to the right-hand side of the slide, what we're showing here is what has been recognized in the 2022 valuation in terms of your past market gains and losses. And so you can see that let's just focus really on 2021 and 2022. Your investment gain, actuarial investment gain for that year was almost 800 million. And what we've recognized is that bottom green portion of the bar, and what has been deferred is the light green portion. So that light green portion is 60% of that total gain. So we're going to recognize 20% of that green bar over the next 3 valuations. And similarly, when we look at that 2022 investment loss of almost $600 million, we've recognized a sliver of that in this valuation, about 120 million, but we will recognize the remaining 80% of that loss over the next 4 years.
So can I just pause? I just want to make sure I understand the 2 charts correctly. Could you go back one, Anne?
Sure.
Okay, so the left chart that says actual versus expected investment earnings, that's showing the market value, is that correct?
Correct, yes.
Okay. And then the right-hand side is the actuarial value of the assets smooth over the 5-year period, is that correct?
No, it's not the actual value of assets, it's those market value, those gains and losses on an actuarial value from the slide on the left. It's the differences in those actual and expected on the right-hand side and how those have been recognized in this valuation.
So when you say recognizing this valuation, could you explain what you mean by that?
You know, the next slide actually goes over that pretty well.
Okay.
And so we can turn to the next slide, and if you still have questions, we can come back to that. So on the left-hand side here, we are showing that calculation of how we get to the actual value of assets from the market value and from all those deferred gains and losses. So we start with the market value of assets, right, at $4.4 billion. And then each of those pieces we're showing here of the last 5 years, what those gains and losses were on an actual value basis. So for this year, we're deferring about $500 million of the $600 million loss. And that is, so in this chart, it shows all of the deferred gains and losses that will be recognized in future valuations. The total of those gains and losses is a $86 million loss. So we're deferring that net loss. Okay, and so to come up with the actual value of assets, deferring that net loss, you add that back into the assets. So the actual value of assets is closer to 4.5 billion versus the 4.4 billion. And we will be recognizing, as I said on the previous slide, recognizing all of those pieces of the gains and losses over the next 4 valuations. Does that answer your question, Maytek?
Yeah, so you're essentially doing an offset for the gains and losses for every single year and then smoothing those for the next 5 years. Is that what you're doing?
Correct. Yes, yes.
Okay.
Right. And so then just on the right-hand side of the slide, we're showing the market versus actual value of assets. And the green line shows you the smoothed assets, the actual value. And it just shows you how that doing the smoothing method, it does smooth the contribution rates because you're not getting these huge jumps in the, when you're valuing your contribution rates and when we're, looking at what your, where you stand as far as their funded status and the contribution rate. So you can see this year, though, that we are almost identical with the actual value and market value. And we haven't really been so close since 2013. But what you can see, look at, if you go back to 2008, it's real interesting when we had that huge, the market crash, the actual value of assets didn't crash. It actually just kind of stayed flat for 4 years. Even though your asset returns the next, few years after the crash were really high, it just flattened out the assets so that you weren't, having a big increase in your contribution rates one year. And then when the assets, bounced back, you don't have a big decrease in your contribution rate. It just keeps your contributions much smoother. So turning to the membership trends, and this is really the chart that shows the maturity of your plans just in terms of your membership. So before 2010, your actives were right around 2,000 for a decent period of time. And then it kind of dipped in 2011 to 2014 to about 1,700. And then it dipped again in 2015 and 16, but since 2017, it's slowly been increasing over the last 5 or 6 years, which is it's a good thing to get that membership back up, because the membership is what, in a way, triggers what the contribution, how much contributions are going into the plan, because your contributions are based on payroll for your normal cost, in your tier 1 UAL and your tier 2. So what's interesting here, though, is your tier 2 members are almost 50% of your total population in 2022. They're actually at about 45% of your active population. But at the same time, your retirees and disabled members and beneficiaries have almost doubled from 1,300 to about 2,500. Same is to be said for your inactive members who've left the system but are still entitled to a deferred benefit when they retire. So what this means is your support ratio, which is your ratio between your active, it's the ratio between your inactive members and your active members, has more than doubled from since 2013, meaning that your population in your plan is very mature, because there's about 1.6 inactive members supported by each active member. And this is not a bad thing. It's we are seeing this all over the country. That's really the point of a pension plan, is you're going to have a maturing population where you have more retirees and actives.
And question, this is Harvey. Does this chart demonstrate that the active membership of our plan has actually decreased over the last 2 decades?
Yes, definitely.
And do you have this chart broken out, split between police and fire, so that we could see how they look relative to each other?
I don't think we have that.
We have the data for it.
Yeah.
But we haven't split the chart.
Yeah.
Although it may be more difficult for us to split the in-pay group between police and fire. But I think that's in the data, so we should be able to.
So we have a combination of 2 things going on here. One, there's less hiring over the last 20 years, but there's a greater increase in retirees.
Right.
Benefits have to be paid on the basis of a smaller
Payroll base.
active membership.
Right, correct.
Is that typical in other mature plans?
I think the support ratio here is a bit higher than other ones we're seeing. We definitely in California, they're all over 1% or the 1.0. I think most are between 1.2 and 1.4. Because you are seeing, we haven't seen quite the decline in active membership that we have in the police and fire plan here. But we did see, this is interesting too, in the last couple of years, we have seen declines in other systems active membership, whereas police and fire the last 3 years have stayed pretty steady and increased a little bit. But it's that big dip back in 2011 that I think it has not, the plan hasn't recovered since then. But it is good to see that there wasn't further dips in the last couple of years like we've seen across California.
And if I may, Mr. Chairman, one other question. Looking at the active deferred, not the active members, but the deferred vested members, there seems to have been over the last 20 years a significant increase in the number of people who are leaving city jobs, but leaving their contributions on deposit, and we will be owing them a retirement when they hit retirement age. It looks like that's a tremendous growth in deferred vested. Was that predicted in your modeling? Is that something that we should pay a little more attention to?
So it definitely is predicted in our modeling. We have termination rates where we expect a number of police and firemen to leave every year. We also predict when these deferred vested members will retire. So it behooves these people, when they do terminate, to leave their contributions on deposit, because the value of that benefit is much greater than the value of a refund, right? So it's not surprising that you're seeing this number through as well, because these people are all, when they leave, they want to remain in the system so that they can collect that retirement benefit.
And in particular, if they go to work for a reciprocal employer.
Yes, yes.
That a lot of these members have done.
Right.
Mr. Chair, if I may, this is Roberto. Good morning, Anne. Good to see you again. I think one of the questions I was going to ask was asked by council, and you responded. The support ratio, how do we compare to our peers across the state? And you mentioned 1.6, so a little beyond that, between versus 1.2 to 1.4, which of course make our system more to be more sensitive to the volatility of the market, right? Number two, I just wanted to make sure you said it, but I want to make sure that we all understand what you mean by that. When you talk about the support ratio and say inactive versus active, in the inactive, you are combining retirees and deferred vested versus the tier 1 and tier 2 active members. I just want to make sure that that's understood.
Yes. And that's a really good point, Roberto, because this support ratio is one of those statistics where a lot of systems, well, I would say not a lot, but it's half and half really, whether or not some systems include that deferred vested population in the support ratio. So by including the deferred vesteds, you are increasing your support ratio, but sometimes this statistic is shown without those deferred vested. So you do need to be careful when you're making comparisons.
Understood. And so now that you mentioned that, clearly from Chiron's standpoint, it makes sense to include the deferred vested. What's their rationale for including it versus not including it for like other systems? In other words, in other plans that Chiron work with in California, you always include the deferred vested as well in the support ratio calculation?
Yeah. So let me just jump in on that, because I've looked at this on national data and who includes it and doesn't include it. The rationale for not including it is the liability for deferred vested is generally much lower than for retirees and beneficiaries. The place it really seems to make a big difference is for teacher retirement systems. They will have a lot of deferred vesteds with very little benefit. And so it would really inflate the statistic. For your system, it obviously makes it larger, but it's not a huge change in what your ratio is. So I think we generally include it, except when there's a situation like that where you have a large number of deferred vesteds with very small liability.
Right, and that can happen too in systems where if they're offering a generous interest crediting to your contributions, a lot of people who aren't even vested, who are just inactive, they'll keep their contributions on deposit to earn a higher return than they could elsewhere. So a lot of systems, not a lot, but some systems who have that kind of plan provision, you'll see a higher inactive population. And with respect to that, as Bill was saying, probably consistent with teachers, you may not want to include it in your support ratio.
Understood. Thank you for the explanation. In other words, what you both are saying is, sure, you can use the support ratio for comparison purposes, but just you want to make sure you're comparing apples to apples.
Yes.
Understood. Thank you both.
Okay, so finally turning to what changed the UAL from last year to this year and taking a look at that. So the UAL based on the actual value of assets decreased by about $80 million from 1.2 billion to about 1.1.5 billion. The main driver of that was the contributions coming into your plan. So that's made up of two pieces. One is your funding policy, where you're contributing a large percent of your UAL payment is going to paying down that principal and not paying down the interest. I mean, you're still paying down the interest, but there's a bigger portion going to your principal. And also the fact that your contribution rates have been coming down over the last few years. So you're getting what used to be contribution delay losses, you're getting contribution delay gains, because in the two previous valuations, you had higher contribution rates. So those higher rates are being contributed for 2022 versus what the 2021 rate actually was. So it just has to do with that timing delay. Next, we actually saw investment gain this year. And that's why we went into that big explanation of those deferred gains and losses, because it doesn't seem logical that we, had these pretty big losses on your assets for 2022, but ended up having a gain. And it's because of that offset from the 2021, the huge gain that we had there, offset by the loss of this year. Then this is the update that we had to the valuation, where our liability experience, we saw a $14 million loss, but compared to the $5.6 billion accrued liability, that's less than 0.3%. So it's a very minimal liability loss. Turning over to the chart on the right-hand side, we're looking at the last 5 years of the liability gains and losses. And this, the scale has been exploded here. Like we're looking at the top of the axis, $50 million compared to 1.3 billion on the left-hand side. So we've blown this up so you can actually see what these impacts are. So we, over the last 5 years, this net liability gain and loss has been about 26 million, which is very small. Some years we've had gains and others losses, and it's largely been driven by the salary increases. And again, those have not been consistently gains or losses. It's just been, 1 year, if you have a big MOU increase, next year it may not be as big. So that's typical in what we see with other systems as well.
I have a quick question on this.
Sure.
When you overlay the support ratio going up, is this intuitive that the liability gains and losses from retirement haven't changed much?
No, I think it's more that on the hiring basis for the police and fire plan, because your inactives have been decreasing. And so when people have been retiring, they have not been replaced as fast as you would have expected. Because with our model, we assume just a stable active population.
Okay, thank you.
So lastly, here we're looking at the historical changes in the UAL over the last 10 years. And the stacked bars represent what those gains and losses have been in each of those valuation years. And then the blue line represents the net gain or loss. So the biggest source over the last decade of your increase in the unfunded has been your assumption changes, about $360 million. Followed by the investment returns on your actuarial value of assets, about 287 million. The liability losses are about 150 million. And again, like the last 5 years, those were mainly due to salary increases. And then in 2016 and 2017, you can see those gray bars are the liability losses in those 2 years. And those are also predominantly as a result of salary increases. There's a small benefit change of about $5 million. But what's really remarkable is the contributions in excess of your tread water. So that is the contributions that are going to pay down your unfunded accrued liability over the normal cost and interest on your UAL. And you can see that each and every year there's been drawdown on UAL because of all these contributions coming into the plan. And that's primarily a result of your funding policy that was in place back since 2014. It's about $340 million, which basically offsets all those assumption changes over the course of the last decade. And just for comparison, I know it's to other systems that we're seeing in California, we are seeing a larger and larger portion of these contributions coming into the plan to pay down unfundeds, but it really has only been over the last 3 or 4 years. This plan is very unique in that sense, where we're seeing it almost every year, except for 2013, which was flat, but every year since 2014, and it's been growing. So those are a very positive trend that we've seen over the last 10 years, and we do see it going forward as well in your projections based on your funding policy.
And go ahead.
Go ahead, Robert.
No, this is just, and maybe we can have this discussion offline, but obviously, I take this information and I make a very, very, very short presentation to the city council on both plans. And this is I guess, an interesting data to share with them, but I'm not really clear as to how you arrive to that access to the tread water. In other words, let me just try to rephrase what you said. There's a payment of the actual liability and the interest on the unfunded liability and the normal cost. And so if that number was 100 million, and you pay whatever interest is due on the normal cost, that'd be 100. But because of our contribution policy, we're asking the city to make payments that are beyond the $100 million. So that delta every year has added up to about 342 million. Is that what you're saying?
Yes, yes. And when you look back at this slide, the contribution slide.
Yes.
So in fiscal year in 2023, this is the
right now.
Correct.
Yes.
So based on your funding policy and where the UAL, and this is on a market value, the UAL, the split here, you're expecting to pay $106 million on the UAL principal based on your funding policy, and only 39 million in interest, and then your 66 in normal costs. That's exactly right. You were right at 100 when you said the 100 million. And so you're paying an identical amount to the principal. Now, next year, it's going to go down a little bit because of the UAL on a market value basis increased, right? Because of the markets. And because there was a loss this year, but you're still paying $70 million in principal and a little bit more in interest, but pretty much the same, and that split again is very unique. On the plans that at least I work on in California, where you're not seeing quite as much of the contributions going to principal on your UAL.
Yeah, so for the city's perspective here, they have been doing a lot to pay down the UAL that it is not common across the country. In fact, across the country, I think it's close to only 50% of plans pay enough to cover the interest on the UAL. And we've seen comparisons to like Chicago,
Yeah,
the contributions. Chicago's contributions are, higher than San Jose's as a percentage of their general fund budget, but they're not even high enough to pay the normal cost plus the interest on the UAL. So our contributions are high, but they are actually driving that UAL down.
And question, Ann or Bill, what's causing the increase in interest on UAL for 2024?
The investment losses.
Oh, got it. Thank you.
all right. Thank you very much. Very good explanation. I may have to ask a few more questions, Bill, in anticipation of my information presentation to the City Council, but that's a good data point so that we can share with them. Thank you.
Yeah, and let me know. I can pull the data on Chicago, although they have several systems, but to give a decent comparison.
Correct, but as a side point, obviously in California, plans are required, right, to make the actuarial calculated contribution by the actuaries, which includes, obviously one of the challenges is that our plans, maybe not as much police and fire or federated, with the funding ratio, the unfunded liability is larger than most of our peers across the state, right? So by definition, they will be paying less interest on the funded liability because it will be smaller, whether it is dollar or whether we're talking about percentage wise, right? So that also has an impact.
Yeah, but to be clear, the federated contribution is not as high above the Treadwater level. So its contribution to pay down the UAL principal is much smaller than this plan.
Correct. Yes.
So,
and that's directly related to their contribution policy as well. And the
it's really what really drives it the most is the length of the amortization period.
Understood. Thank you.
I have a quick question. When you see assumption changes here, is this essentially the discount rate assumption? Or
There's also mortality in that too, but it is essentially the discount rate.
And so this is 358 million cumulatively over 10 years.
Correct.
Okay.
All the purple bars on the left-hand side, if you added those up.
So it's about 35 million per year if you think about it on average.
Yes.
And it's worth pointing out, Sunita, that I joined in April of 2011, so I've had exactly 10 complete fiscal years on the board, as have Dick, as have all of you independents.
Question. How many discount rate changes has there been over the last decade then to cause this?
Well, we've gone from,
I think it was 7.125 at the beginning of 2013.
Was it 7.125 then? Okay.
I mean,
for a while, we were decreasing an eighth of a percent every year pretty consistently. So yeah, we probably did it 7 or 8 times over that decade.
I mean, honestly, the last 10 years have been basically, historically incredibly low interest rates. So 35 million on such a large plan doesn't seem so severe. I don't know, maybe my intuition is wrong, but that's sort of what my gut is saying.
David, I know there's 2 slides in this presentation, or 2 slide decks. On the second slide deck, slide 14, at the very bottom, it shows the assumed rate of return since 2012, so the last 10 years. I'll give you an idea of how many changes we've made since then.
I think we had, I
Thank you.
had
Yeah.
it in here in the appendix, maybe. There.
There it is. Just past it. 22.
Thank you.
Yeah, so we were 7.5 in 2012, went to 7.25 in 2013, and then we started our 1/8 per year kind of adjustments.
Hey, Bill and Ann, I just want to make sure that the board is clear. In this presentation, you're presenting two different things. One is the preliminary valuation results, which are not final, as one topic. And now we're transitioning into the deferred action that we had from last meeting regarding the economic assumptions for discount rate and whatnot that we deferred from last meeting. Is that correct?
Exactly. So,
Okay.
so these, this presentation of the preliminary results does not include any changes you may make in assumptions this year. It's also not final. We are still dotting i's and crossing t's on the valuation, and even there was a data correction we spotted yesterday. So there are a few things still changing, but we do not expect any material change to these results. But wanted to give you this context for the discussion of the deferred action on the economic assumptions.
Okay, and then so Chair Lanza, just for the clarity of the records, this agenda item has two components to it. I would recommend that the board defer action on the preliminary results on the evaluation, and so that we have the final numbers that Chiron can present to us at the next meeting for final approval. However, we may take discussion and action on the economic assumptions.
Thanks. That's super helpful, Maytech. I'll remember that when the time comes.
All right, so I don't want to repeat the entire presentation from last month on the assumptions, but just wanted to kind of hit the highlights. We've seen inflation's been in the news even more in the last month. It's remained high. The Fed's increased interest rates yesterday to try and combat it. The forecasts are still showing that inflation's expected to be high over the next year or two, but come back down. We proposed increasing the current assumption from 2.25% to 2.5%, really reflecting those longer term expectations that we're seeing from forecasters, from the break-even rates in the market, and from investment consultants. So that's our recommendation on inflation. On wage inflation, we're definitely seeing an uptick in the short term, reflecting some of the increases in inflation. Where it goes long term, it is less clear. And so we had suggested that you consider increasing the long-term assumption from 3% to 3.25%. But we note that we often look to the bargaining agreements to see where they kind of level out at. And there is no current agreement for police and fires in the last year of their agreement, and the increase that's built in there is 3%. You can see that the recent history has been much higher than 3%. So that's a potential consideration that would increase the costs, and we have an estimate for that. The amortization payment increase rate, so the payments on that unfunded liability are scheduled to increase by a certain amount each year. We've tied that historically over the last several years, we've tied that increase rate to our inflation assumption. And so if we increase our inflation assumption, we would increase that rate. That means very slightly lower payments in the near term and very slightly larger payments in the long end of the amortization periods. So it's just a slight tweak to the city's contribution based on the UAL.
Bill, question on that. Should that be tied to wage inflation instead of price inflation, since it's a function of payroll?
So, we've gone through this discussion before, that there's a range from a typical range from a level dollar amount up to a wage inflation amount. Wage inflation is, if you use that, the idea is that each payment going forward is the same percentage of payroll. But that assumes that payroll grows at the wage inflation rate. What we don't want is for the payment to actually grow faster than payroll. So to add a level of conservatism, your system and other systems have been backing off from that wage inflation rate. And a few years ago, we decided a good place was inflation. And I think S&P Global, the bond rating agency, uses that as kind of a benchmark when they're evaluating plans. And so that means that you anticipate that each payment will be the same real dollar amount. So it's a slightly more conservative approach than using wage inflation. And then the big issue is always what to do with the discount rate. And it was more confusing this year than in most years because there's been significant changes in the markets. We've seen a significant increase in interest rates, significant reduction in valuations in the market. And that's caused capital market assumptions to increase pretty significantly. And so we showed that here with Makita's assumptions that were developed last December, or those developed this year in June. And there's been just a significant increase. We've suggested that we hold the discount rate at its 6.625 this year, because we wouldn't want to increase the discount rate based on these new capital market assumptions just to have the market reverse and have us have to reduce the discount rate. And so before making any move, we'd like to see if those market conditions persist. And so we review this assumption every year, and we will have another shot next year to look at it. So we're recommending no change right now, but if market conditions remain like this, you may be looking at starting to move the discount rate up instead of down. If we fall into a recession, we may be back to the same story we've had for the last decade or so, where there's pressure to reduce the discount rate.
Bill?
Yeah.
Question. I see on this graph that in 2019, there's also a blip up in the expected return on assets. And
yes.
I guess I'm trying to remember what happened in 2019. I can't.
Okay, so it was a very
kind of refresh my memory as to why there was a blip there, and then whereas all the other periods been pretty consistent, and then why there's another blip here. Is this all from Makita or the consultant?
Yeah, these are Makita's assumptions. The bottom numbers, their 10-year assumption, and the top numbers, their 20-year. So it gives you the 10 to 20-year range. And all of them, except for this last one, are their normal capital market assumptions that are developed in December of the prior year. And in December 2018, there was an uptick in interest rates and the stock market dropped significantly. And so that changed the price earnings ratios and all the capital market assumptions. That had completely reversed itself, I think, by the end of the first quarter of 2019. And so we knew it when we were discussing this, that the market conditions had changed back to what they were before. But that is the cautionary tale about where we are now, that there's a lot of uncertainty in the market, and things could change quickly.
Thank you.
So this summarizes the recommendations. I think that the one thing we've kind of tweaked for this presentation is if you think we may be considering a discount rate increase next year, we think it would be fine to delay the wage inflation increase until next year. The issue is if we increase the wage inflation this year, it will increase costs as shown here on the right-hand side. But then if we increase the discount rate next year, that would reduce costs. And so it makes sense to consider those actions at the same time. So because they're kind of offsetting effects. And so, you know, we do think there's enough data to say that our wage inflation assumption is likely to need to increase a little. But it's not enough to force us to make the move this year. So we could delay it. But if you're thinking that we're not going to increase the discount rate in the future, that we're going to hold it constant, then we would suggest that you increase the wage inflation assumption this year.
Does that wrap it up, Bill?
That wraps it up. Take any other questions.
Let me jump in first. So if you remember a month ago, we sort of engaged in debates. Sunita sort of led one side, I sort of led the other, about, so what is happening with inflation? So let me give you my 2 cents, and Sunita can jump in, or anybody wants to jump in. So I'm an old man, and old people have the advantages of having seen a lot. Dick has seen this. Harvey, you're an old guy, you've seen this. So my father fought in World War II. I'm sort of know everything from 45 on. I took my first job, I got my degree in 78. So I've seen inflation, and most of you haven't. Look, there were 2 regimes of inflation post-World War II. The first one ran from about 1945 to about 1991, and it averaged about 4.25%. And then something very strange happened. It makes sense to me because my first house mortgage, kids, was 16%. I got it in 1986. Let me tell you, 16% mortgage drives you nuts. Of course, again, 20% salary increase every year. And this is why folks hate inflation, right? Because it scrambles the deck. The regime from 1991 to 2021, that 30-year period, as Bill alluded to, showed inflation of about 2.25%. Now, those are regimes. And so I asked myself the question, well, when should pension funds, Makita, our staff, have noticed that something was different with inflation? So statistics, we would have noticed a 2 sigma deviation from 4.25%, 2.25% in about 2008. And son of a gun, if we didn't sort of notice it right around the time of the crash. And so this board, composed of independents, the board I joined in 2011, has been driven by this new inflation regime. And we picked it up early. Surprisingly, we were in this new regime for over 20 years before a lot of people realized we were in a new regime. So the real question to my mind is, are we going to go back to the old regime of higher inflation rates, or are we going to return to the new regime of lower inflation rates? Okay, now I'm going to make a political commentary. I'm not a Republican. I'm not a Democrat. My parents raised me. Politics is a four-letter word. Politicians are so-and-sos and such and such. Look, the truth is that I think as citizens, we don't like inflation. I think bankers and pension funds don't like inflations. But as we witness with the current staff in the White House, if it's politically expedient to raise inflation, they will, right? Everybody knew Biden was going to drive inflation through the roof, and some of them he didn't deliver right on time, right? So I think it's unknowable what will happen with inflation because politics are involved, and you cannot forecast politics. So the question for you, Bill, and you've sort of answered this in emails to me, is if we predict high inflation, we get high inflation, we're okay. If we predict low inflation and we get low inflation, we're okay. But Bill, I've asked you this via email. So for the board, which is better for the pension fund? If we predict low inflation but get high inflation, or if we predict high inflation but get low inflation? Bill, which of those is the more conservative way to think?
Well, so first, let's just think through how the liabilities work for the pension plan. For the people who are retired in tier 1, they are just getting a 3% annual increase to their benefit, regardless of inflation. Their benefit doesn't change whether inflation's 0 or 10%. They just get a 3% increase. There is a guaranteed purchasing power floor, but most of the retirees are way above that floor. So we'd have to have a long period of inflation above 3% before that comes into play. That's the lion's share of our liabilities right now. Tier 2, they are subject to inflation, but their COLAs are capped at 2%. So high inflation, their benefits are only going to increase at 2%. Low inflation, their benefits won't increase as much. Now, for active employees, the inflation, not immediately, but over time, is reflected in salary increases. And so higher inflation environments, active members will earn higher benefits. And low inflation environments, they'll earn lower benefits. But that's less than a third of our liability right now is attributable to actives. So, so on the liability side, inflation does not have a large direct impact to how we project the liabilities. Over time, it certainly would for the tier 2 members, because they're much more based on active membership. Now, from the sponsor point of view, in terms of paying for it, high inflation means that those future dollars are cheaper, right? And if you're looking at interest rates adjusting to the level of inflation, that's also going to affect our future investment returns. And so what has really hurt pension plans in terms of their funding and the sponsor contributions has been the decline in interest rates, which came with the decline in inflation and caused us to have to reduce our capital market assumptions. So, so it's a long way of saying that I think it's more conservative for us to keep our discount rate where it is and consistent with that. We want the inflation assumption to be realistic, but a lower inflation assumption, especially if it's still above 2%, is probably as conservative as we can get.
And if I could just comment from the investment perspective, obviously Bill gave a good synopsis of how inflation affects different parts of his actuarial assumptions, but I think he hit the nail on the head that on the investment side, what matters more is inflation's impact on rates and how the Fed responds. And that's where you get into politics, Chair Lanza. But, I think, one sort of other dynamic is that as rates continue to increase, as the Fed tries to combat inflation, we may eventually end up going back closer to an environment where we used to have, where bond returns and bond yields are getting closer and closer to your discount rate. So that's maybe another thing to consider as you think about going forward. But in terms of setting the discount rate, even though Makita's expectations for capital market expectations for different asset class returns have gone up in this environment, we as a firm, are not generally recommending that plans raise their discount rates in response to that, because as Bill mentioned, things can reverse easily.
So Sunita, jump in and tell us we're all crazy or that all makes sense or whatever you're thinking.
Yeah, thanks for entertaining my sort of, I guess, being devil's advocate last time. Certainly a month has passed and had more time to think about it. And I think I agree with the philosophy that our investment expected return should be more sticky and see what happens, particularly in a volatile year like this. Making a change for a plan that has a very long horizon is probably not. I've warmed up to the thought that that's not a good idea. This is, we sort of smooth a lot of our returns, and it's a good idea for us to wait and see how the markets react by next year, and also maybe have a bit more discussion in the investment committee around risk premiums and sort of future returns in a revised interest rate environment. So I'm very comfortable with leaving the discount rate where it is. So as far as the inflation goes, I think, so I don't see an inconsistency with raising inflation assumptions a little bit and keeping the returns constant. I guess that's where I am.
So Sunita, you already know, I think very highly of you. Had trustees on pension plans been you, we wouldn't have all been in this big hole we were in. So I mentioned that we noticed we were at a 2 sigma deviation in 2018, but we passed a 1 sigma deviation in inflation rates back in like 2000, right? And had people noticed that and said something interesting is going on here, and then they started slowly to ratchet down discount rates, we taxpayers would have trillions of dollars more in funding in these pension plans. So let's keep folks, that's a compliment to Sunita for raising the right question last time, which is, hey, this is a big deal, man. Let's noodle on it. And she and I went offline with Bill and Ann and noodled on it. It kind of makes me think, Sunita, I've been sort of doing this in the background. We should be looking at equities and bonds, inflation, and wages, and look for these 1 to 2 sigma deviations off historical norms. Ultimately, folks, everything we do is based on the past. Makita tells us their forecast. Well, their forecast is half based on the past and half based on how smart people think the future will deviate from the past. So let's go around, because I've sort of stolen the floor, but Andrew, you got any questions?
I got one quick question. It's actually a little bit different from what we've been discussing. On this page, we see the member and cities contributions. On the members' contributions, over the last 10 years, they've been slowly but surely been going up year after year. I know wage inflation definitely has a role in it, but all the other economic assumptions, are we going over those assumptions, which is causing the membership's contributions to go up? I'm trying to figure out because it's this slow, steady incline that we've had for years, and normal cost is going up. I'm curious what in particular is is causing it, and is if our assumptions are wrong or not that we're using.
Yeah, I don't think it's really the assumptions that are driving that too much. Clearly, the wage inflation assumption and the discount rate have material impacts to that normal cost rate, and so the member contribution. The other thing to keep in mind, though, is that the normal cost rate is actually an average of all the individuals in the plan. And so for a normal open plan, you kind of expect new people come in, retirees go out, and the demographic balance stays kind of constant. With tier one, that's not happening because we have people going out, but no new people coming in. And so the demographics of tier one are shifting around. And so there's some movement in that average normal cost rate as those demographics change.
Would you expect or anticipate that the members' contribution rates would sort of level out at some point? Or do you predict this is going to keep on climbing up slowly?
They can climb up or go down depending on how that demographic balance works out. I think, I think we'll continue to see small movements for, I haven't looked specifically, but I think probably for like the next decade or so, we'll see small movements. When we get down to very few tier one members, it could get more volatile.
Okay. Okay, thank you, Bill. But overall, on this discussion, I'm for keeping the discount rate at the current level for two reasons. I mean, ever since 2008-9, when we were once 100% funded, we've been trying to climb out a hole ever since, and to do that is through contributions and returns. If we raise the discount rate, contributions will be coming down. And then with the uncertainty of the current market and economy, I just don't feel like, I don't feel confident yet that, we're going to be getting high returns, especially since we're down 1% already fiscal year. So I'm for keeping the discount rate at the current 6 5/8.
Thanks, Andrew. David Kwan, want to ask anything or weigh in?
No questions, just a couple of comments. One, I'm pretty comfortable with the recommendation by Chiron, so I have no issues. Second comment is that, related to inflation, I guess I may appear young, but I'm pretty old myself too. So, Drew, I'm probably in your camp, and based on my experience, and this is just anecdotal, inflation tends to be sticky. And I think that once it breaks out of its low level band that it's been, hovering around the last couple of years, it's hard to bring back down. So I guess that's why I'm comfortable with all the recommendation that you've made, Bill. So that's it.
Yeah, let me jump in. Yeah, David, I agree. And the other thing too is that as a citizen, as a guy that goes out and buys pizzas, I like low inflation, but I recognize that low inflation also has some really deleterious effects. You sort of see stagflation in Japan and so on. So yeah, it's sticky, and maybe a slightly higher number is better than a lower number. Let's see, Sunita, you want to weigh in or ask any more questions?
I was just going to make a joke that I think when you talk about age, you're assuming that women who don't lose hair and don't have hair are young. Good that I made you feel that way, but no, I'm old too. So
you're not as old as I am, trust me. Howard, any questions, comments?
Yeah, thank you, Bill and Ann, for the presentation. With respect to the recommendations, I fully agree. I echo what Andrew said. In this time of volatility, I don't think it's prudent to change the discount rate right now. I do have a question, and maybe this is for Roberto or Pam. Is the expectation with respect to the members and the city in line with what we have here on slide 16 that it's going to go up? And hopefully that won't be a surprise given the market.
Is Pam on the meeting?
I'm here.
Go
but
ahead, Pam.
Roberto, I was hoping you'd take that before I did. You know, I'm listening to this discussion and we all know what's happening in the market, but I think any change to the discount rate would increase the cost of the unfunded liabilities for the city, and I'm sure they're budgeting that. There are already risks of financial implications of sales tax income and other things that we may not be able to depend on next year, property taxes, etc. There's a lot of impact on our general fund next year, including the increase in wages that we are in the middle of negotiating with the POA right now, that I'm not sure I can report what's going on, so I'll just leave it at that. But there are discussions about raising salaries all around, so that's going to have a huge effect on our general fund. I hope that you keep things as they are, because we cannot afford to increase, but we'll of course take on whatever liability we have to. That's my best punt of an answer.
Very well done, Pam. Thank you so much. So from my discussions with city staff, and more specifically with the budget director, I think the expectation has been over time that when the boards change the discount rate, they decrease it rather than increase it. They were a little stunned by an email communication that I shared with them just recently, where I actually told them that changing the discount rate can go both ways, can go up or down. And they were surprised. So I think, I don't want to speak for them, but I think the expectation is that if there are any changes to the discount rate, they were really honestly thinking it may go down. So they'll be happy to see that there is no change. And I actually have to say that from the budget standpoint, I don't pretend to understand how the budget, they do the budget for the city, but I think they expect some nominal increases on the contributions every year. So I think they'd be pleasantly surprised that at least on the preliminary numbers, it suggests that contributions may not go up next year. Of course, then again, in my presentation to the city council last year, I made a huge point on the total net gain of on the 5-year, I'm going to say 5 years, smoothing the gains that were yet to be accounted for or recognized, only to find out that this year that total net gain now is a total net loss for 2022. But that's not my fault. That's Bill's and Ann. So I will make sure I put the fall where it belongs, and because they do the numbers, it's not our office. Obviously, I'm joking about that, but yeah, they will be happy that the rate will not go down, and it looks like, again, I recognize these are preliminary numbers, the contributions may actually decrease a bit from the current fiscal year. I hope that answered your question.
Okay, thanks. And thanks. And Drew, one last thing. I do remember that interest rate regime where I actually had a mortgage in the 17% range, and I thought that was the normal. So I totally understand how sticky it can be. That's it. Thank you.
Thanks. Ashar, questions, comments?
Yeah, so good discussion. As I said last month, I think let's keep the discount rate unchanged. Let's see how things play out over the next year or so. And I think to Andrew's point, so far this fiscal year, we're, I guess about 1/3 of the way in or so. Returns are -1%, as Prabhu said. So we're probably going to end the year, barring some big changes, a bit more on the whole, I guess. Given our returns may be below our expected returns. So no change in the discount rate. I support that. And I think in terms of wage inflation, if you look at slide 11, And the fact that our assumptions have always been lower than what's the real increase in wage inflation, maybe changing it to 3.25 may be the right thing to do.
Great. Dick, any questions or comments?
Yeah, just some comments, Drew. As you stated, we were both here when it was 7.50, whatever have you, all the way down to 6.62. There was a lot of criticism during our time about the discount rate and PERS system and what we were doing. So I thought this board and Bill and Chevron everyone did an excellent job. Some questions I have is the retirement age, like example, I think it was something like averaging 27 years. Bill, has that gone down to 25 or 23?
I don't recall
Years
where
of
the
service.
average is now. I don't think it has moved a whole lot. We did, during the Great Recession, we had a period where a whole lot of people retired. But since then, we've kind of returned to normal patterns of retirement.
The comment I have also is that, yes, the retirees are very blessed to get the 3%. I totally understand that. The question I have is, and I know we don't negotiate, but I was just curious. If one of the criticisms in San Jose is that when it comes to retirement benefits, our present members don't get the same as most law enforcement and firefighters throughout the state of California. And I was wondering if there was more incentives in the retirement, would people, present day members, stay on longer? And would that have the effect on the amount of money being paid in? Because with the mortality rate, living longer, they're serving less time and living longer. That means they're paying in less. Any comment on that?
I think that's a difficult question for us to answer. There's obviously a lot of factors that determine whether someone comes to work for San Jose and how long they work. The retirement plan is certainly a part of that. Where we've seen significant issues, it's been it's been where they put in a defined contribution plan. Clearly, they've had trouble recruiting police officers and firefighters if they've done that. But when you have two tiers, it's more complex to analyze.
Well, thank you.
Thanks, Dick. Franco, questions, comments?
Nope.
Thank you much. Dave Wilson, questions, comments?
No, no questions, and just reiterate what other people said. I'm good staying at 6625. Thanks.
Great. I'll take the prerogative to make the motion. There's a lot of moving parts here. So first, let's recall, well, first of all, we're on item 3A. And the thing we're looking to approve is slide 16 titled board decisions. First, as Maytag points out, there are two pieces to this presentation. One was the preliminary results. We're not deciding on that. We'll see that again in the next board meeting. But we do want to approve the economic assumptions that were held over from last month. The economic assumptions are on this slide 16 titled board decisions. There is one, I will make the motion that we approve these, but I would like to, I heard what you said, Eshwar, but I think I'd go with Bill. Let's withhold for a year, increasing the wage inflation assumption from 3 to 3.25. Let's leave it at 3, because the whole thing with incentive compensation may have an impact on the discount rate. The discount rate, I think, will be modified one way or the other next year, but we won't know until we get the numbers. So I will make a motion. We approve everything on the slide and keep wage inflation to 3% for another year. Do I have a second?
Second by Santos.
I got a motion by Lansing. Any discussion before we go around for the vote? Great.
See if there's any public discussion.
Oh, I'm sorry. Thank you. From the public, want to make any comments or questions? Thanks, Harvey. Andrew.
Aye.
Good. David
Aye.
Klein, Sunita,
Aye.
Howard,
Yes.
Burr,
Aye.
Dick,
Yes,
Franco,
Aye.
Dave,
Aye.
Chair Lanza, I vote aye as well. Hey, I'm Harvey and Maytag. Rich had a good idea. Let's bump your item 3B on the Brown Act to a little bit later. I actually think we're going to have extra time. And if we do, I'd love for you guys to take more time because I know this comes up every now and then, and it is actually a very important subject.
That's fine. You want to go to the other actuarial item?
Yeah, exactly, Bill. So back to you.
Okay, just a minute. Let me bring it up here.
That'd be item 4C, Mr. Chairman.
The OPEB piece.
Okay, I think I've pulled this off now. Hopefully you're seeing my screen. This item's on the assumptions for the OPEB actuarial valuation. Mike Shunning is our health actuary. He unfortunately can't be here today because he is caught up in Hurricane Lisa. And I got an email from him this morning. He's fine, but does not have any internet access and limited cell phone access. So I'm going to pretend to be a health actuary today as well as a pension actuary. So the OPEB plan or retirement medical plan is mostly closed. The main benefits are only available to tier 1 members who did not elect a transfer to the VIVA. Everyone else can still get benefits under this, but only under a catastrophic disability. And the benefits under that are limited. Member contributions, unlike in the pension plan where they're affected by our assumptions, in the OPEB plan, they're just fixed at 8% of pay and they don't change with anything. Our contribution, our role is to set the city contributions. And so we have policies in place to establish contributions for the city. The city has an option though, to cap those contributions at 11% of pay. We've been right around that limit and actually slightly above it the last couple of years. But so far, the city has not exercised that option. They've contributed the full amount. So this valuation, like for the pension, is to develop the city's contribution for the 2024 fiscal year. Now, retiree medical plans are a little different than pension plans. And they're one of the things that you will hear us talk about is the implicit subsidy and the explicit subsidy. For the board, we are just pre-funding the explicit subsidy, but we are also required to calculate the implicit subsidy and disclose it. But the pre-funding is really just for the explicit subsidy. That subsidy is that the plan pays the premium for the health coverage selected by the retiree up to the cost of the lowest cost plan offered to active employees. And so this chart on the right gives a little bit of an illustration of what's going on. The cost for healthcare varies by age. It varies by a lot of things, but one of the overriding factors is age. And as you get older, the expected claims go up. But when premiums are set, they set based on the entire population that's being covered and charge one rate. And so they set one premium that covers that entire population. That population is both the active employees and the retired employees. And specifically here, the implicit subsidy comes in for pre-Medicare retirees combined with actives. And so the the level premium is made up, and this is for the Anthem Select PPO plan, which is a richer plan than the lowest cost plan. The explicit subsidy would pay the premium for the lowest cost plan, and then the retiree pays the difference up to this level of premium that doesn't vary by age. But then we assess the value or the costs of the claims by age. And so for these ages in here, which is largely retirees, there's an implicit subsidy for their claims costs that's effectively built into the premiums for younger people. And so when we talk about the implicit subsidy, that's all we're talking about. And it's really just a disclosure in our valuation. It is an integral part of the financial statement liability for the plan. But in terms of pre-funding, we are just focused on the explicit subsidy. We updated our projections for the investment returns. We have not, these projections do not have any changes to the liability amounts. You can see the healthcare trusts also lost money during 2022. And so the projection of the assets starts at a lower point, but it's still projected to grow pretty significantly. The funded status has dropped for police from 41 to 38, but is still projected to increase rapidly. On the contribution side, you can see member contributions are projected to go down as the members who are covered under this plan retire and leave the city. So those contributions are expected to go down. The city's contributions are expected to go up. The blue line shows what we were projecting in 2021. So obviously the line is higher now with the effect of the investment returns. For the fire group, you see a very similar sort of change in pattern. They were 38% funded, they've dropped to 35% funded, but projected to grow. Similar impact on the contribution projection. I would note the liabilities here are much, much smaller than the pension plan. So we're looking here at projecting the liability up for fire to like 375 million out in 2040. That's a drop in the bucket compared to the liability we have on the pension side. So before we get to the assumptions, in the actuarial audit, there was a recommendation that we talk about the contribution policy a little bit for OPEB, and specifically how the amortization and asset smoothing differs from the pension plan. So city contributions under the OPEB plan, like under the pension, are effectively the normal cost piece, an administrative expense piece, and an unfunded liability amortization piece, minus member contributions. What we've done differently here is we are not smoothing assets. Anne just went through how the asset smoothing works for the pension plan. For the OPEB plan, we do not smooth the assets, but we build in a smoothing into the amortization. So we have a 25-year amortization with a 3-year phase in and phase out, and that's the smoothing piece. And the payments increase each year with wage inflation. Now here, part of the reason we're doing the wage inflation increase is, remember, the city has that optional cap that is a fixed percentage of wages. And so we're trying to kind of target fitting ourselves around that cap. We're not recommending a change to this method, but wanted to explain what's going on and why we're using this as opposed to the smoothing method on the pension side. So when you do asset smoothing, and here I'm going to assume we do 3-year asset smoothing instead of 5-year. What happens when you have an investment gain or loss is you recognize a third of it and you set up an amortization schedule for that third. And then the next year you recognize another third of it and you set up another amortization method. And then the third year you set up a third amortization. And so in effect, for 1 year of investment losses, you have, if you're using 3-year smoothing, you have 3 different amortizations for it. The method we're using essentially replicates that by just building it into the amortization schedule. So we don't have to go through the asset smoothing, it builds it in. Now, what's the difference? The main difference here is this applies both to changes in liabilities and to changes in assets. And we also use it for assumptions. So it's used across the board on all those items. Whereas for the pension, this mechanism with asset smoothing is only smoothing the investment gains and losses. Well, why do we look at pension and OPEB differently? Well, if you're looking at a pension, the source of volatility is overwhelmingly from the investment returns. So here the gold, and I've made positive and negative all positive. So we're just focusing on the volatility from these different sources. The gold is from investment returns. The gray is from liability changes, and the purple is from assumption changes. And looking at the last 10 years and then taking the average. And you can see that the investment returns on the pension have been significantly more volatile than assumption changes or liability experience. When you look at OPEB, however, it's kind of the reverse. And that's because healthcare costs change. They change every year. Our trend assumptions change every year for healthcare. And that really moves the liability measure around significantly. And so the gray bars, again, are the change in the liabilities. The purple are the assumption changes, which are dominated by those changes in trend. And so over the 10-year period, it's actually the liability experience and the assumption changes that's more than twice as volatile as the investment returns. Even the 2021 investment return, this is on a market value basis, was not as significant as the liability experience. And that was a very big investment year. So to smooth out the contributions on the pension side, it's really important to smooth the investment returns. But on the OPEB side, we really need to smooth all of it because the liability and the assumption changes are going to move the contributions around a lot. And so that's why we've gone with this other methodology, because it smooths both the liability measures and assumption changes. Any questions on that before I switch gears to the assumptions? Okay. So for the OPEB plan, we use all the assumptions from the pension plan where they're applicable. So both the economic, so the price inflation, we just changed. Wage inflation does not have a big impact, but it is used kind of tangentially in the OPEB valuation. Retirement rates, mortality, all of that, we use all the same assumptions. But we have a number of assumptions that are unique to the OPEB plan. They're different from the pension plan, and so we need to address those. They're listed here. I'm going to kind of go through them in order. Some of them I'm going to go very quickly because we're not suggesting much of a change. But to start out with, wanted to report what we're seeing so far in the healthcare cost changes. And so this is largely built around the premiums. This chart shows the premium for the lowest cost health plan, which is what drives the explicit subsidy. It's the maximum explicit subsidy. And you can see the approximate increase historically. Last year, it was down 0.5%. This year, on average, it's about 5.9% increase. Well, it is a 5.9% increase for the lowest cost plan. So that is slightly lower than we expected. We expected an increase of 7 2/3%, but it's a little bit lower, but we won't get the kind of gain we got last year out of that. All the pre-Medicare plans receive the maximum subsidy. All the Medicare eligible plans have premiums below the maximum subsidy. So just to summarize what happened there, we expected an increase of a little over 4%. We got an 11% reduction in the Kaiser premiums, and that covers 43% of the population. And then we got about a 5% increase in the rest of the population. Rest of the plans, it covers about 57% of the population. So there's a little bit of a split there, but on balance, we'd expect a gain because of the 11% reduction in premiums for Kaiser. Looking historically, the healthcare trends have bounced around a lot. I think a lot of us, we talked about remembering and having scars from high inflation. More recently, a lot of us have a good memory and scars from high healthcare cost increases. And you can see those in the early 2000s, but they have come down quite a bit. And so over 20 years, the Medicare trend has been around 4%. And the pre-Medicare trend has been around 6%. So we develop our assumptions going forward using what's called the Getson model. It's published by the Society of Actuaries. It's something that's very commonly used to develop these trend assumptions and is the work of a combination of actuaries from different firms, along with some academics and others. So the philosophy behind it is basically you look at short-term expectations for costs, set those for the next 3 to 5 years, and then have that adjust down to a long-run trend, which is based on expected GDP growth plus an expected excess medical cost growth. And the current recommended assumption in the Getson model, or base assumption for that, is 1% excess medical cost growth. And then from there, over a longer period, grading down to just GDP growth. And the idea is that healthcare costs cannot continue to grow faster than GDP forever, because ultimately then all our economy would be is healthcare. So we have tweaked these assumptions a little bit from last year. There's a slight increase in the pre-Medicare short-term trends, a slight decrease in the post-Medicare short-term trends. Then the inflation assumption increasing from 2.25 to 2.5 is driving most of the remaining difference here. We are extending the period that it's expected to be at that 5% rate. So that's the most significant assumption change we're recommending. We also look at plan elections over the prior year and over the last 5 years. There was a new plan adopted last year, and we just made a rough estimate that we thought only 1% of the population would elect it. Turned out 3% elected it, and there's some adjustment there. So these items in red are the only changes we're recommending. Everything else has stayed pretty consistent with our assumptions. And this is just a minor tweak. We also looked at what tier elections. So our retirees electing only to cover themselves, to cover themselves and a spouse, children, family coverage, and those elections differ significantly between males and females. And so we looked at experience over the last 5 years for these elections, and we're recommending some tweaks. Really for males, moving away from retiree only and retiree and spouse to more family coverage. So we're seeing greater levels of family coverage for pre-Medicare males. Then for Medicare, we just assume that the children drop off. And so any retiree and family goes to retiree and spouse, and any retiree with children gets added to the retiree home. So, and those are remaining pretty constant. For females, it's about half are continuing to only cover the retiree. There's been some movement a little bit towards retiree and children and retiree and spouse, and a decline in retiree and family. So these kind of offset the adjustments for males. The other interesting thing in this plan is a few years ago, Measure F added an in lieu option. So retirees, instead of electing coverage or not electing coverage, could elect an in lieu option, and they get a credit to an account, a notional account equal to 25% of the benefit they would have received by going into the in lieu option. And then they reserve the right later to come back and enter the plan and use that credit to help pay for their premiums in addition to the coverage offered by the plan. We don't have a lot of data so far because it's only been in effect for 4 to 5 years. And so we started out with just some guesstimates of where things would be. And we are now suggesting a couple minor adjustments. One here is we're seeing a little more people collect retiree and spouse credits as opposed to retiree only credits. So this is the only adjustment to the assumed coverage tier that they would qualify for if they go in lieu. And then the probability that they elect in lieu has not really changed. So it's about 30% of active members elect in lieu when they retire, and 50% of vested terminated members. So we'll continue monitoring these, but those coverage levels or election levels have remained constant. I missed one here. I didn't talk about it at least. Which the one we really don't know about is once someone goes in lieu, how long are they going to stay there? We've had an assumption of 5 years. The program hasn't even been around for 5 years. So we really don't have any data on that. I just wanted to point out we're still continuing with that assumption, even though while we're watching the data emerge, but it will be a while before we have anything reliable on that. Administrative expenses, we assume an amount per member. I won't go through this whole analysis, but we're seeing it's not increasing as fast as we had expected. We have it increase at 3% a year, which would have the rate be a little bit above 43. So we're suggesting decreasing that rate to $42 per member, reflecting our experience. And then you may have seen this idea before, but we have to set the discount rate. The discount rate here is 6%. The asset allocation is different, but we have the same basic dynamic that the discount rate based on assumptions set, capital market assumptions from December, the 6% lands right in the middle of that range. But now the new interim assumptions have it much higher. And so it's this chart looks very similar to what we had before. The numbers are slightly lower because the asset allocation is lower, but we're recommending the same thing, that we just keep the discount rate at 6% and wait and see what happens. Now, I would say I'll preempt this to Drew's question about the effect of inflation. Inflation has a much bigger effect on these liabilities because healthcare costs are expected to adjust for inflation. So if we get high inflation, we do expect that to affect healthcare costs over the long run. But in summary, really the significant changes on the healthcare trend rates, and that's really driven by the 25 basis point increase in price inflation. The other assumptions are just minor tweaks we're recommending and no change to the discount rate. So with that, take any questions. We are looking for action on this item.
We don't have to go round robin on this. Floor is open. Anybody have any questions or comments? Just jump in. Anybody? Roberto, public, anybody?
I have one question, if I may, Mr. Chairman.
Yeah.
Yeah, thanks, Bill. It's not on this page, but I noticed in a previous slide that we've put the amortization of the unfunded liability for OPEB on a 25-year amortization schedule, right?
Correct.
So I noticed elsewhere on our agenda today, we have in the communications section, I think it's under 1.5D, if I remember correctly, we have a copy of the state auditor's report on the fiscal health of California cities. And it includes OPEB obligations and OPEB funding. And for San Jose, it appears to indicate that San Jose's OPEB obligations are pretty modest. But then it puts in the high risk category the city's OPEB funding. And I'm wondering whether or not, advertently or inadvertently, we're contributing to an increased heightened risk to the city for its OPEB funding by using a 25-year amortization schedule so that, you know, they're, for the first 10 years, they're not even paying anything towards principal on the OPEB. Could you sort that out and tie that in a little bit? Yeah, are we inadvertently creating higher risk to the city's funding of OPEB by stringing out the amortization of the unfunded liability over 25 years instead of, say, 15 years?
Yeah, well, the 15 years would definitely improve the speed with which we get OPEB funded. We adopted a 25-year approach for a couple reasons, recognizing that it does spread it out over a longer period. One is we started with no funding fairly recently. And so we are trying to go from 0 to 100. And when you look at that in terms of generational equity, there is much more of an argument to spread it out over a longer period. That does, raise, some risk levels, because the shorter you fund it, the better in terms of the funding risk. But there were two other things. One, the city has an optional cap at 11% of pay. And so we designed this based on our estimates at the time to come in very close to that 11% of pay, so that we are capturing most of what could be collected under the cap. We have gone above the cap, but not significantly above the cap. And so if we went significantly above the cap, I think it would be much more likely that the city would invoke their 11% cap. The other consideration is quite simply how small the OPEB liabilities are compared to the pension liabilities. And to the extent we wanted to get the unfunded liability under control, the priority really is much more on the pension side, especially because those liabilities are much firmer in their measurement. I showed the volatility in the measure of the liability each year on the OPEB side. And so those numbers do change much more significantly from year to year. And in fact, the sponsor has other controls that they can use to change those liabilities. And they have, by changing, for example, the lowest cost health plan that is available to active members. That has a direct impact on what our liabilities are and are projected to be. So I think it's appropriate to place the emphasis on closing the unfunded liability on the pension plan more quickly than on the OPEB plan. But certainly we want to build up the funding in the OPEB plan as well. And so the discussion at the time, and this was, I think 2017 or 18, was really trying to balance those interests and needs.
Okay, thank you for that. I'm wondering whether we need to revisit that, because this board is a separate trustee of the OPEB, the 115 trust, and has an obligation to its funding separate and apart from its obligation as trustees of the pension trust. And I'm just wondering whether or not we need to revisit that, Mr. Chairman, because the rating agencies look at reports like the auditor's report on the health of California cities in terms of their OPEB funding. And it may have an impact in the credit rating of the city. And if we're contributing inadvertently to creating higher risk for the city and higher cost for the city, I think it's something, and not improving the funding of our OPEB obligations, I think it's something that we should take into consideration. Thanks very much.
How would you propose dealing with that, Harvey? Just putting it on a future agenda?
Well, I think I can't remember, Bill will have to remind us when we take up we're not taking up the assumptions here. We're not taking up or are we, Bill, the amortization methodology?
Well, we did put the asset smoothing and amortization method on the agenda here, but it was primarily in the context of, should we be smoothing assets instead of using the phase in, phase out amortization?
Yeah. The problem, Mr. Chairman, the increased risk to the city based on a 25-year amortization is that to spread the unfunded liability over that lengthy period of time means that for 7, 8, 9, 10 years, there's no principal reduction at all. The city is only picking up interest on the unfunded liability. So we're not paying down that unfunded liability that keeps increasing with inflation by a nickel for several years. And I'm not sure that that's in the city's best interests, or whether it's in the best interests of those of us who serve as trustees of the plan to achieve funding of the OPEB obligations. So if this is an appropriate time to take that up because it's agendized and it's on this chart, we could start the dialogue on that. I didn't mean to just kind of throw it in to the hopper, but it was something that I think has a significant impact. And because it ties in so directly with that auditor's report that's on our agenda, and I see San Jose shine, like a lot of other cities in bright red risk category, is something I think we ought to have a conversation about.
Well, correct me if I'm wrong, Bill. When I looked at this, it's like a mortgage, right, Bill? And the point of a mortgage is if you're paying back principal and interest, and you're on a flat stream of payments, in the early years, you're paying back mostly interest. Am I kind of got that right, Bill?
Yeah, I think the difference is in a typical mortgage, the payments are the same dollar amount each year.
Yeah.
And here we have payments increasing both during the phase-in period and then 3% each year after that. So I didn't look to see kind of where we are in the balance of that now. Because we've had credits under that, so we're not taking the full interest credit reduction in our contribution rate as well. So there is some balance. I'm not quite sure where we stand right now compared to normal cost plus interest. But I would say we have been increasing the funding percentage for these plans. And I know from the rating agency's perspective, what we're doing is well ahead of what most other systems are doing out there in terms of the liabilities. California is probably, excuse me, probably a little bit more ahead of the curve, but an awful lot of the systems, even in California, are not pre-funding.
Well, maybe let me just make a suggestion, Harvey. Maybe Bill and Harvey, you guys go offline, and maybe the right thing is, Bill, at the next board meeting, maybe you and Harvey put your heads together and see if there are other mechanisms that have more risk, less risk, whatever. I mean, we're just applying curved filters to these things. Does that make sense, Harvey and Bill?
Well, I'd suggest this might be a good topic for something like a retreat or a longer session to get into. If you want to address it in the short term, the question is just, do you want to increase the city's contribution requirement this year to the OPEB plan? And if so, we could come back with something to do that. But my sense would be let's go ahead and go through this valuation, but have the bigger conversation maybe in the spring again, and kind of revisit what we're doing in terms of funding these plans.
Yeah, you suggested that last board meeting, Bill. I actually like the idea of an offsite that covers all these different assumptions, smoothing periods, shapes of curves, as soon as it says inflation. Yeah, that's probably a good idea. Harvey, is that adequate, or do you want to talk about it now?
No, we don't have to talk about it now in depth. And that's like I say, I didn't mean to throw that into the board's hopper this morning necessarily. Bill is right. The city has shown commendable responsibility in wanting to pay down and not adhere to the ceiling they've put on themselves, but to actually pay down more and assure the OPEB funding. And then that's been a commendable approach the city has had for the last several years. And I'm wondering whether we're artificially keeping the city from really assuring the funding of OPEB by stringing out the payment schedule for so long. But it's something that we should take up at another time as part of an overall approach to the funding of the OPEB obligations.
This is a much broader issue. I mean, my little diatribe 45 minutes ago was all about, you take your eyes off a single ball like inflation, and all of a sudden you're in the red trillions of dollars. So I like this idea that look, you guys keep telling us we're smarter than the average bear. I like this idea that periodically we're really digging into these mortality assumptions, the inflation assumptions, the wage increase assumptions. I like that idea, Bill. I'll take it up with you offline. Floor is still open. Any more questions?
Yeah, I have a very micro question. Yeah, if I look at this page, Bill, it says price inflation at 2.5%. And it seems like that's an input to the Getson model, which is on page 27. You sort of describe it.
Yes.
Okay, so is that 4.97% an output of the Getson model?
Yeah, that, let me go down to that. So the 4.97% is a combination of these three assumptions: the price inflation of 2.5%, real per capita GDP growth of 1.4%, and excess medical cost growth of 1%. Those are all the baseline assumptions in the Getson model. We can modify them as long as we have justification for it. We have modified inflation in the past, and sometimes it's to the real GDP per capita.
But the output of the model is a 4.97% increase in medical costs. Is that what the model does?
Yes, that's its baseline increase in medical costs before you adjust for capacity constraints and short-term changes.
Okay, but I guess the question is, we just voted on keeping our other inflation assumption at 3%, right?
No, we increased the price inflation from 2.25% to 2.5%. We voted to keep the wage inflation at 3%.
Ah, okay, so price versus wage. Okay, got it. That was my. All right, thank you.
Sure. Floor is open. Any more questions? Hey, Bill, go back to the board decision slide, will you? Because that's what we're going to be voting on. So there was that thing about wage increase, Bill. This is a hard recommendation, right? There's wiggle room here.
For which one?
Oh, I made a motion that said, let's take what's on the slide, but set wage inflation at 3% and not 3.25%. Is any similar phenomenon here?
No, there's not.
No. Then I'll entertain a motion to approve slide 23, board decisions.
So move, Santos.
I got a motion by Santos, so I have a second.
A second by Sunita.
Great. Andrew.
Aye.
David Kwan.
Aye.
Sunita.
Aye.
Howard Lee.
Yes.
Eshvar.
Aye.
Dick.
Yes.
Franco. Dave Wilson.
Aye.
I'm Chair Lanza. I vote aye. I'm showing 10:36. Let's take a 4-minute break to 10:40. When we come back, we'll pick it up with Roberto and Pam, everybody. 4 minutes. So, hey, Roberto, over to you. He's not back. Let's give him a minute.
Apologies.
You're fine, Roberto.
Sure.
Over to you.
Thank you. So good morning, everyone. Just have a few comments, if you bear with me for my oral update. The first one is that just yesterday we had our open enrollment health fair, and for all the members, retirees of both plans. And as far as I understand, it was a success. We had quite a few members attending, probably around 100 or maybe a little more. I know staff has been working behind the scenes on getting the open enrollment, including sending the open enrollment packets late last week to all the retirees. So kudos to staff for your hard work and making this a successful open enrollment fair, which it was the first fair that we have had in person since we started the COVID-19 3 years ago. So again, great job all around. There's still a lot of work to be done. Obviously, there have to be the selections made, the healthcare selections made by all the members. If they have any changes, there's still a lot of work to be done. I know staff have been working for months with the city and the vendors to make this a reality. And of course, there's still a lot of web presentations by the vendors for the rest of the month that members can participate in. And I'm sure they're going to be contacting staff at the office with questions. So once again, congratulations and thank you to staff for the work. And if there are any questions by members, please feel free, have the member contact our office and we'll be happy to help them. To that extent, we actually had a new health staff specialist starting with the office last October 17. That's Donna Hepp. Donna actually came to us from another department of the city. She's been at the city with 30 years, and so a lot of experience and understanding of the city processes. So welcome, Donna, to the oral staff, and in particular to the health care staff. So congratulations. Along the information for the benefit staff, we also are in the final stages of the senior supervisor position. So we have made an offer, and we're going to be welcoming someone soon to that position. Just recently, just last October 2028, Marty Sadater, you remember Marty, for most of the time, Michelle actually covers the police and fire board and committee meetings, and Marty does the federated. She actually retired after 30 years of service with the city. So we want to congratulate Marty on her retirement and wish her a long and healthy retirement. Their Fed board at the last meeting actually approved her retirement application, so which allowed her to retire. So again, congratulations to Marty, which means that we do have a new staff. It's a temp working with Linda and Michelle. So we're going to politely ask you to be patient as Linda and Michelle actually onboard this new staff and help her through the process to understand and this transition to understand the duties so she can be helpful and help the team. So once again, congratulations to Morty. Staff before the open enrollment actually made a presentation to the POA last Thursday, October 13. Again, I heard it was a success. So I just want to give staff kudos for making the presentation. It was a dual job, right? There were some staff members making a presentation to the Federated Retiree Association. That was actually a remote meeting, but this presentation was actually in person to the POA. So again, congratulations and thank you to staff. And then I want to close by actually touching on those 4 members whose current trusteeship position ends November 30th. Let me start with Trustee Santos. And I had a chance to share some information with Trustee Santos early this morning. There were not applications for his position, which means that his application was accepted by the city clerk, and they're working on a timing to bring his interview in front of the council for reappointment later this month. As to the other 3 positions, I understand 2 of the trustees have actually applied already or are in the process of applying. I heard for the 3rd one, and the trustee is also interested in applying. We would love to have all of you back, if at all possible. And so for those that have applied, thank you. And the city is working diligently on making sure that the application is accepted and that they work on actually scheduling an interview in front of the city council later this month. I think that the city will be able to work out the details on getting those interviews before the end of the month. But in any situation that that's not the case, not to worry. So long as you are willing to continue serving, you are able to continue serving with the board until your reappointment is addressed by the city council and hopefully approved. At that point, then it will be for another 4 more years. So that concludes my presentation or my report, Mr. Chair, other than I do want to congratulate Trustee Santos. I fully expect the appointment to be made by the council later this month. So another 4 more years, not to be a politician, but we look forward to working with Trustee Santos for another 4 years. So thank you, Mr. Chair. I'm happy to answer any questions.
Floor is open. Any comments, questions for Roberto?
Ray Storms has his hand up.
Jump in.
Thanks, Roberto. Just had a question. Is 1.1 going to be talked about today or not?
You mean the 1.1 on the consent, the disability application?
Yes.
Yeah, that was addressed early this morning during the consent. I defer back to the chair. I think Trustee Lanza did address that issue and pull the item. And there was actually a recommendation by the board to approve the recommendation by the committee. But if the board wants to make any other comments or you have any specific questions, Ray, please go ahead.
No, I've been on since you guys started the meeting this morning. And I saw that it was pulled from the consent calendar. Is there just going to be a discussion on that particular 1.1 or has it been already dealt with? I
didn't pull it. I just wanted to make the comment that the fact we rejected it should not be an indication that we didn't believe the officer, merely that we didn't have enough data to verify the disability. We didn't pull it.
Okay, so nothing else is being done with that at this time. It's still considered denied.
Yeah. I mean, if data comes up, the applicant's certainly willing to reapply, but there just, you were probably there at the meeting with disability, just wasn't enough data to go on. Yeah.
Okay, thank you. That's all. That was the only question I had. You guys have a good day. Thank you.
Thank you, Ray.
Bye.
Floor still open. Any comments, questions for Roberto? If not, Pam, over to you.
Good enough. Thank you. Just a couple of things. One, I met with Cheryl Parkman and Councilmember Davis to discuss the joint meeting that we traditionally have around this time. And we agreed that the best time to hold it is actually after a new city council is seated, so that we can have a discussion hopefully centered around unfunded liabilities. There may be other things that we need to discuss in the joint meeting between the trustees and the city council, but we felt it was really important to wait until the new council is here, because we're going to have at least 3 new council members and potentially a new mayor that will, or a mayor who is not a current city council person, let me put it that way, who will benefit from a long discussion around, or a discussion around unfunded liabilities. Additionally, we decided to take a look at moving it to late February in consideration of budget issues, because what happens at the retirement boards will and the unfunded liabilities will affect our budget. So it will be important for the city council members to understand the relationship of the unfunded liabilities to the budget making process. So we're looking at that. It is election season, so there's a lot in flux right now. The next few council meetings will be really busy as current seated council members try to wrap things up before they are no longer council members and before they term out. And as you all know, it's no mystery, this is the middle of crazy political season, and hopefully that will be all over on Tuesday. And then with that will come certainty. At least we'll know who the mayor will be and who our new city council members will be. And that may change things dramatically, or it may not. We'll just have to see. But there's a lot of uncertainty, and I would say uncertainty sits with staff, but it also sits with council members like myself wondering who's going to be our next mayor, what's the focus going to be, how are we going to move forward, and then the new 2 or 3 new council colleagues who come in. With that, I also want to mention and welcome back, I guess, Trustee Santos, who will come before us for an interview. But these interviews will likely to be virtual, and because our agenda is going to be impacted for the next few months, we'll likely be cutting them short and moving quickly to interview and move forward on appointing trustees, because we know you need to have trustees. With that, I think that's it for me. We are in the middle, I mentioned it earlier, in the middle of negotiations with the POA. I don't believe I can disclose any of that yet, but there may be someone here who has more information than me than I can disclose, or they can disclose, but I don't think we're ready to do that. And then we've also been discussing with fire about the EMTs, and that's on our agenda next week or 2 weeks. With that, I'll take any questions.
Mr. Chair, I do want to thank Pam for reminding you board that the joint meeting with the city council was extended or deferred to the new year. It's been 10 years I've been working for the board, Pam, and I keep forgetting sometimes when I speak to one board that I didn't tell the other board. In this case was that meeting. I did tell the federated and forgot to mention that to police and fire, because in my mind, I have already told them. But you are absolutely correct with Matt, with Cheryl, and both of you, council members for police and fire and federated, and it will be deferred. And I think the key point that you made, which is true, is to have that meeting before the new mayor's budget discussion, right? So that questions can be asked and there's an understanding. Of course, by then we'll have the final numbers from both valuations. So we'll know how that unfunded liability is, what the impact of the contributions are, and everything else. So thank you for that reminder.
Well, Roberto, it gave me something to talk about. Thank you.
Floor is open. Any questions or comments for Councilwoman Foley? All right. If not, we covered item 4C in conjunction with 3A. Chiron did them both together. 4D, over to you, Roberto. Schedule.
Thank you, Mr. Chair. What you have before you is the tentative 2023 schedule of board and standing committee meetings. And this is based on having your board meeting the first Thursday of every month for the next 12 months, except for the month of July. And your committee meetings, which are usually on a quarterly basis, except for your disability committee. And then your investment committee that I think is meeting, and I defer to Prabhu, mostly either quarterly or every other month, although sometimes that have to be addressed. With that, I would just recommend that you approve the proposed 2023 scheduled meetings as presented. Of course, we are happy to address any questions that you may have.
Great. Floor is open. Any questions or comments on this?
My only comment will be that meetings will continue to be held through Zoom remotely for as long as we can. I keep trying to get council to tell me when we're going to go back to have meetings in person, but as a very good attorney, they always qualify their comments. Bottom line is they do not know. We suspect it's sometime in 2023 early, but it's hard to say which month. So.
Okay, since we have Pam here from the city council, do you have a sense, Pam, of when what the city is going to do with regard to the social distancing resolutions? Because that's the main driving force on which we're predicating our AB 361 findings.
Really good question. The governor has indicated that the emergency order will be removed by the end of February. That is like, we are already back in session in person for city council, although we are operating hybrid. I don't know, Maytac, to respond directly to your question, when we will be shifting that to 100% in person. But for the time being, we're still going to be hybrid as a city council through February. And whether that changes at that point where we'll be 100% in person with only public being able to comment virtually, I don't know yet. We haven't reached a conclusion on that.
Any other questions for?
Hey, Drew.
Yeah, go ahead, jump in.
I've been meaning to ask this. I hope I'm not out of order here, but I'm wondering, is there a possibility of moving the start time from 8:30 to 9? Personally, just getting my kids out of the house it's always a hassle. When we start meeting in person, it's going to become a little bit of a constraint. So,
I don't know. It's been 8:30 for Roberto. Is it hard to change that?
I don't think it will be hard, but I don't even know. I suspect that the meetings that are required by the Munico are the actual day, not the actual time. But I don't even know that for a fact.
Yeah.
By the way, this is all because California has changed the rule for secondary schools to start not before 8:30. I would love to throw my kids out before then, but the law changed last year.
Look into that and get back to Sunita and the board, right?
Yeah, so we'll look into that and get back to you as a chair, and we'll let Sunita know. And of course, I think it's a fair request. Obviously, this is something that the full board will have to entertain if the change is possible at a future meeting, right? Yeah. And lastly, I do want to say something. My staff just reminded me. I mentioned committee meetings on a quarterly basis. JPC is actually scheduled to meet monthly for the next few months. for the remaining of 22 and maybe for the first few months of 2023, that's the only committee that may not be meeting quarterly again, except for disability, which means monthly, and JPC for the next few months will continue to meeting monthly. Thank you.
Great. Nominations for position of board chair and vice chair.
Mr. Chair, I think
We need a motion.
required an action, and there was no motion for the schedule presented.
Motion by Santos to approve the
Hey,
schedule.
4D motion by Santos. Do I have a second?
Second by Gardner.
Let's go around. Andrew.
Aye.
Quan.
Aye.
Aye.
Yes.
Aye.
Dick.
Yes.
Franco.
Aye.
Dave Wilson.
Aye.
And I'm Chair Lansdale. I vote aye as well. So we've got a new twist on nominations for board chair and vice chair. We actually have two new twists. One is, you'll recall, we used to stagger them, but Harvey, I think, made a good suggestion. Now we do them at the same time. I'm going to turn the floor to Andrew in a second. You remember, it's supposed to be 2 years for chairman, but I started a year early. So I'm sort of half offset. And I got approached to ask if I'd be willing to do one more year, and I'm open to it. So Andrew's kind of been wandering around in the background. Andrew, can I turn the floor over to you?
Sure, happy to. Yeah, historically, we've always done, the chair, we for 2-year terms for the most part, although we approve them every single year, and it'll typically rotate from plan member to non-plan member between chair and vice chair. Drew's been at this. He came in halfway through. Is this 2.5 years now, I believe, or 2 years he finished. So typically we would try and vote and rotate. With my position being termed up in a year, and that'll finish 8 years for me, I don't know what my future is going to hold. And I believe I would really like to have stability in the chair and vice chair spot. So my recommendation is going to be and ask if Drew would stay on one more year, and Franco would come on as vice chair. And then, over the next year, they could transition and work together where Franco would, in a year become chair. That was my thinking and my recommendation. I'm not sure if we're going to do one recommendation at a time. If so, but I'd like to have Drew do another year. And when we get to the vice chair, I'm going to recommend Franco, see if he'll be willing to step up.
I was thinking that, Santos.
Well, are those nominations, Trustee Gardner?
Yes, that's correct. Those will be nominations.
Okay, thank you.
I'd like to stay in for another year because we're right in the middle of incentive compensation, and we've got a great team working on it with Eshfar, Andrew, and myself. And I'd really like to see that through. I've been working on it off and on for 7 or 8 years, and I'd like to sort of stay in the thick of that. So I very much would like to stay on as chairman. Franco, are you willing to be a vice chairman?
Yes.
Great. Is there a second for those nominations?
No need for a second.
Oh, that's right.
Chairman.
Does anybody else want to nominate anybody else?
I'm just wondering where Andrew's going.
I'm not going anywhere. So I just know my term is coming up in a year, and if I decide to make changes, then I would like there to be stability, in those two positions. And I thought this would be the best segue, but it doesn't mean I'm leaving.
Don't worry, Steve. When the time comes, I'm gonna work on them. I'm pretty good at keeping people. All right, hey, Harvey, this is what I think we're gonna have in mind. Just gonna now over to you, Maytac, and you've got plenty of time, Harvey.
Okay, so the nominations are now closed on that item. Is that correct?
Yeah. Yeah, I didn't hear you.
All right, so at the next meeting, there will be a vote.
Right. So Harvey, over to you, 3B on the Ralph M. Brown Act. And this is what I think Rich was hoping. You've got plenty of time.
Do you
Go through
want to
this.
do item 4F just since we have the quorum of the board in case anyone needs to leave?
Yeah,
or-
sure. Yeah. Whatever you want to do, Maytag. That's something
Yeah,
makes sense.
let's do that just in case anyone.
Oh.
dropped-
Are you anticipating something, Maytag?
We know how to clear a room, man.
It's clicks, and so it will, might as well get it out of the way since we're on it. So with the backup materials for item 4F, we have information that would support this board's factual findings to allow the board to continue to meet virtually under AB 361, which is one, that the governor's proclamation continues to be in place, and two, that the city council continues to recommend social distancing in city facilities. With these two factual findings adopted by majority vote, then this board may continue to meet virtually for the next 30 days. Thank you.
All right. So based on the information presented by Maytag, that we've still got a state of emergency and the council is in support of that. Do I have a motion to adopt those two factual findings?
So moved by Santos.
Got a motion by Santos. Do I have a second?
Second, Gardenier.
Great. All right, let's go around to Andrew.
Aye.
David Kwan.
Aye.
Sunita.
Aye.
Howard.
Yes.
Ishvar.
Aye.
Dick.
Yes.
Franco.
Aye.
And Dave Wilson.
Aye.
I vote aye as well. We almost got that done under 60 seconds, Maytag. That's amazing. Okay.
Right. We've
Over
got-
to you and Harvey.
Great. So if I could please share my screen. Oh, I have sharing screen. Thank you. Please let me know if you can see my screen.
Yep, we've got it.
Okay, great. So Harvey and I wanted to do a presentation for the board because there's been a number of questions over the last few months regarding the Brown Act compliance, what it requires and whatnot. And so we thought it would be appropriate to do a refresher with the board of the basic rules and answer any questions that you may have. So today's presentation will go through the basics and also cover a new legislative change that the last legislative session had passed. They passed a new bill called AB 2449, which provides the board another option to meet virtually in hybrid fashion. But as I'll explain further in the presentation, it's really an untenable model to work with. It's very cumbersome. And so I'll go over that law with you, but the basic rules and requirements are provided in your backup materials. If you want to take a closer look at those rules relating to hybrid attendance for board meetings, please reference those materials. And we will close out with hypotheticals led by our trustee advisor, Mr. Luderman. So first, why do we have a Brown Act? Now, this goes to the fundamental American policy for open and accountable government. And so the Brown Act is designed to allow the public to have meaningful access to the board as elected officials and the decision makers over the plan's administration for the funds. For the members, excuse me. So all governing bodies and standing committees are defined as a permanent committee with an unlimited duration. So for example, the governance committee would be a standing committee of the local public agency. They must conduct all their business in noticed and open meetings and allow the public a right to attend, observe, and comment. So the prime pillars of the Brown Act are 1, notice issues, 2, open meetings that allow the public a right to attend, comment, or observe. So those are the key tenets of the Brown Act. Now, there's something called an ad hoc committee. This board had created an ad hoc committee for VC investment issues. And the difference between an ad hoc committee and a standing committee is this. An ad hoc committee exists for a limited period of time for a very specific purpose. And most importantly, it has with membership less than a quorum of the full board. If a committee is deemed an ad hoc committee with meeting those 3 requirements, again, defined and limited purpose, existing for a limited period of time, and the membership is less than the quorum of the board, they do not need to comply with the Brown Act. So they do not need to comply with the Brown Act's notice and posting requirements. They do not need to comply with, the minutes and any of the other public access requirements for members to attend those meetings in either in person or virtually. Now, the city also has a similar law provided under the city's municipal code, which is relating to the Sunshine Ordinance. And the purpose of the city's Sunshine Ordinance is to achieve the same purpose under the Brown Act, but it provides rules specific to legislative bodies that are related to the city of San Jose. So for the purposes of the Brown Act, what counts as a meeting? The guiding star for what counts as a meeting is any gathering of a quorum of the board. Now, this could be in person, this could be on the phone, this could be via Zoom. It doesn't matter what sort of medium it is. The main point is if there's any gathering of a quorum of the board, it counts as a meeting for the purposes of the Brown Act. And this includes serial meetings, which I'll cover in the next slide. But whenever determining whether or not the meeting is governed by the Brown Act, consider whether there's a gathering of a quorum of the board or the committee. Now, there's an exception to the rule, which is conferences and social gatherings of general interest. So, for example, the SACers or CalPERS conferences that you may attend. The caveat there is that while you're attending these conferences or social gatherings and there's a quorum of the board, as long as you don't discuss any board business, then it does not count as a meeting of the board. So attending a conference with all the trustees attending, although it has a quorum, it does not violate the Brown Act, require you to post that you are all going to that meeting. So let's talk about serial meetings, because this is where the Brown Act gets really tricky. In serial meetings is where the spirit of the law favors open and public meetings, and that takes precedence over the form of the law. So now, we talked about earlier that the guiding star for whether the Brown Act applies is whether there's a quorum of the board. So a quorum of the board can be achieved through a series of communications, and that will bring the communications within the scope of the Brown Act. So let me give you an example, a chain of communication. So this is when member A trustee A talks to trustee B, who communicates the information, and trustee B takes the information they learned from trustee A and then communicates it to trustee C. So you see the information of gathering consensus and deliberation of an issue being discussed amongst the various trustees in a chain of communication in a way that may, by the letter of the law, evade the Brown Act. It's technically outside the scope because not physically all three people are in the same physical location, but the spirit of the law is triggered because the information, it goes from trustee A to trustee B to trustee C to trustee D. And if it reaches a quorum of the board of all that information gathered outside the public meeting, that technically falls within the Brown Act and may result in a Brown Act violation. Now, this also applies to another form of communication, which Harvey and I like to call the hub and spokes communication. And let me give you an example of this. There's an individual who's collecting information from independent streams of each of the trustees. So one person collecting the information is the hub, and the trustees are on the outer rim are the spokes. It's a one-way flow of communication to the hub from each of the various trustees. And the hub then takes all the information gathered from the various trustees and communicates it out back to the board. And so that is considered a hubs and spoke communication, and that too falls within the purview of the Brown Act if a quorum of the board is triggered in terms of that form of communication. So the problem with serial meetings and why it's tricky is that it collects all the information in a way where it's difficult to track whether a quorum of the board is triggered. And so it's difficult to determine, whether the Brown Act is being violated. However, it is advisable to be careful when you are communicating information amongst yourselves, to be mindful that your email may be forwarded on to another trustee, and that email may eventually be forwarded on sufficiently far enough that a quorum of the board is triggered. In addition to that logistical problem, as a matter of policy, the reason why serial meetings trigger the Brown Act or fall within the Brown Act is that the positions and views of the members are gathered in terms of consensus and decided outside the context of a public meeting. And so the public has no way to persuade the public members or trustees to change their positions because the discussion and deliberation all occurred outside the public meeting. And that's the whole purpose of the Brown Act, is that we should be able to have access to our public officials, weigh in as a public and comment and be offered an opportunity to persuade them on the positions before a decision is finally made. And from a fiduciary standpoint, it's important for the board to be mindful of the value of open and deliberate, open and public deliberation, because it's important to prudent decision-making. It shows that you're being thoughtful and deliberate, take all viewpoints into account, and achieve a decision in a way that has been vetted. And so having that sort of deliberation made in public is important, because if we were to, for example, be challenged on any decision based on abuse of discretion, we would have a record of our deliberations. Now,
let me throw in a comment here, Maytag, if I may. For those members of the boards who are appointed members, who are not members of the system and come from a private business background, this is so contrary to your natural instinct about the way business is done and the way business is done efficiently. This is not a very efficient, it's not a nod to efficiency by any means. And it's a real difference between business in the public sector and business in the private sector. It's just very difficult. You're used to being able to pick up the phone and send a text to somebody or have a conversation, persuade them of your position, and be able to move on. And this runs completely counter to that instinct that you have in your private lives in terms of persuading each other and cutting deals and reaching agreements so that you can have a more efficient meeting and not waste a lot of time. This is a nod to how the public interest outweighs the efficiencies of decision-making when you're dealing with public monies in a public context. So it's just, it just runs counter to your private instincts about how is the best way to get business done. But that's what we're given when we come into the public sector.
Yeah, speaking, I've crossed this line a few times, and what I find so hard, Harvey, is it's not just the making decisions part's easy. Even in small company boards, you get everybody involved in making a decision. It's that second one. It's that communications. You can't even do homework in the background, which is the part that I always get hung up on. I'll ask people, well, what should we do about what's the number, 4 or 5? But you can't do that either. So that's really the place you run in trouble, is you can't even really talk about something just for information, right, Harvey?
That's right.
Exactly so. And you can talk about what's going to be on an agenda, because you're not really talking about the substance. You just, so that's okay. But it is difficult for a chair, particularly, because you kind of want to be able to reach consensus. I mean, your instinct is, let's see if we can get some consensus on something so that we can move it forward. And you just can't do that until you're all in the same meeting that is open to the public. And so it's a struggle, and it goes against human instinct, but that's why you get paid the big bucks for it.
And also too, just to kind of piggyback on it, it goes to the third bullet point here, is that actual concurrence is unnecessary. So it's not just limited to gathering outside of the public meeting. It's any sort of communications relating to board actions or information or the business outside of the public meeting. So actual concurrence, so consensus building is not necessary for the Brown Act to be triggered. Again, it's literally the number of people who are on the communication. It's a quorum of the board that dictates whether the Brown Act applies. Now, there is an exception to the rule, and that's where staff is answering questions or providing information to the board in a one-way fashion. So for example, when we get the agenda and the backup materials, there's a one-way email that we all get that says very bold at the bottom of the email, please do not reply all. That's designed to prevent that communication from falling in the Brown Act. So what are meetings? Can writings count as meetings? Yes. For example, we've discussed earlier, an email communication can count as a writing or a meeting. Emails, texts, chats. Again, the thing that matters is the number of people who are involved on the communication, not the medium on which it's made. So another thing too to be mindful is that even though we've got, if a communication does fall within the Brown Act, just posting it or otherwise making it public doesn't sanitize it from a violation of the Brown Act. And all writings that are circulated to the board, putting the Brown Act aside, are also discoverable under the California Public Records Act. So that's another thing to be mindful of, what you put in writing and circulate amongst yourselves as trustees. The only exception to that disclosure of public writings is any confidential communications you have with your attorneys, meaning either Harvey or myself. And so in addition to the Brown Act disclosure requirements for limitations on who can be involved in the communications before the Brown Act's triggered, there is an additional layer for this board to be aware of, which is the Public Records Act. And so there was a case specific to the city of San Jose that came out a number of years ago, which concluded that even if the board members were communicating on their private devices, for example, text messaging on a private device, your own cell phone, those communications, if it's relating to public, the public's right to know the information under the California Public Records Act, for example, business of the board, that too becomes discoverable under the California Public Records Act. So if it's your private email, your private cell phone, you're transacting information regarding the board business, all of that is counted as writing that are discoverable under the Public Records Act. I see a hand up from Trustee Gardner.
Yeah, thank you. Just one quick question. So on communications to you and Harvey, who's going to determine what's considered confidential, and or is all communications with you guys considered confidential?
Not all communications with your attorneys are considered confidential. The only types of communications that fall within this exception are attorney-client privileged information. So for example, if you're seeking counsel from either Harvey and I on a legal issue that requires advice from a legal standpoint, that's covered. But if it's not triggering any sort of legal analysis that you're seeking from your attorney, that doesn't necessarily mean it's covered and accepted. Harvey, do you want to weigh in on that?
Yeah, I would say, because you don't want to make that determination on the fly, Andrew, that it's best to consider any communication that you have with counsel, Maytag or myself, for example, as confidential, and treat it confidentially and not disclose it to others. The privilege of confidentiality is held by the entire board. And so ultimately it would be a decision the board would make as to whether or not to treat it as confidential. But I would say, as a default setting, anytime you include us in a communication, it should be treated as if it were confidential until established otherwise.
Okay, thank you.
And counsel, you usually, at least when you communicate with staff, you usually will know in your email client attorney privilege, right? So I always look for that. If you include that in your communication, then to me is.
We do that, but I would say we probably honor it more in the breach, Roberto, just because being efficient, we don't always slap the label on it necessarily. But if you were doing a search for communications in your Outlook folder, for example, and you searched for either Maytag or myself as the recipient or the sender, you could gather those and treat them all as confidential until we sort through it otherwise.
That's right. And so in our communications, Harvey and I don't always put on the attorney-client privilege marker at the top. That does not mean that any email that we have transacted without that legend is not confidential. And so, as Harvey had mentioned, it's really a legal judgment call. And so if there's any questions with regard to whether something should be treated as confidential, please send it to Harvey or me, and we will take a look at that and help the board make a determination. Now, so going back to the Brown Act, as I mentioned earlier, one of the key tenets of the Brown Act is notice to the public regarding the type of business that's going to be transacted for the legislative body at the upcoming meeting. And so as you'll see here, the Brown Act has very particularized rules about when we need to put notice up, when the backup materials need to be provided to the public. And the reason being is that we need to provide sufficient notice to members of the public to know what sort of business is going to be conducted, what's going to be discussed, so they can make an educated determination of whether or not they feel it's necessary for them to attend that meeting. So for example, Ray Storms came earlier today. He saw on our agenda that we had a disability issue that he wanted to weigh in. And so he was able to look at the agenda and see what we were going to cover. Now, under the Brown Act, it requires a 72-hour advance notice and posting of our agenda. For the city of San Jose, their sunshine ordinance is 7 days in advance of the meeting. And that has resulted in our practice of waiving sunshine. And the reason for that is that under the state law, we have 72 hours before the meeting to post our agenda and our backup materials. However, under the San Jose sunshine ordinance, we have 7 days. And so the state law takes precedent over the San Jose municipal code, and that results in our practice of waiving sunshine. Because so long as we comply with the Brown Act in terms of posting, we can waive sunshine for the state municipal code provisions.
Just for the record, Tech, we've never had a case where we've waived sunshine on anything even to the least bit controversial. And if it was controversial, we might think twice about waiving sunshine.
Well, as long as it's posted within the 72-hour advance notice requirements under the Brown Act, we are in compliance with open meeting laws. And so another thing too is the agendas must be publicly available, so they're required to be posted on the website. Special meetings, which you are all familiar with the AB 361 process that we have in place, is that for those meetings, it's a 24-hour advance notice and posting, and no other business may be conducted at that special meeting. It's for a limited purpose. Most importantly, special meetings cannot be used for executive compensation decisions. Anything else may be called within a special meeting if called by the chair or the majority of the board. Matters that are not agendized cannot be discussed. Again, this goes back to the notice to the public regarding the business that the legislative body is intending to conduct at the upcoming meeting. If a matter is not agendized and we do discuss it, that would be blindsiding the public. The only exception to that rule is when there's an immediate action that arose since the agenda posting. So for example, we posted the agenda within 72 hours notice, but there's an emergency circumstance that happened within those 27 hours that requires board action. And so we may take action on that item so long as there's a 2/3 vote of the board present, or if that's not possible, a unanimous vote if 2/3 is not present to consider the matter. So because the Brown Act has a strong public policy to allow members of the public to have access to the decision makers in government, including this board, the Brown Act imposes a very difficult regime for teleconferencing in general. This is true even under the traditional Brown Act rules. So under the traditional Brown Act rules, it requires that if any member is not at the physical location where the board is scheduled to meet within the jurisdiction of the board, the agenda must post all the teleconference locations of that members, and the members of the public must have access to that place. So for example, if we were under traditional Brown Act rules and you're taking the meetings today from your house's address will be posted, and any member of the public may come to your house, enter your house, and be there with you for the duration of the meeting. In addition, each of the teleconference locations must be ADA accessible to the public. And during any teleconference meeting, at least a quorum of the board must be in the jurisdiction where the agency has jurisdiction to legislate matters over. So we're all familiar with AB 361. I won't go into this in any great detail. The main thing, as I've discussed before, is the proclamation of the state of emergency must exist in order for us to utilize AB 361. Of note, the governor's proclamation is scheduled to burn off at the end of February. So we will only have a very limited time left with our dear AB 361. As I mentioned earlier, the legislature did pass a new Brown Act alternative for hybrid meetings. As I'll explain, it's very cumbersome, and you can see the further details in the slide deck. But as a threshold matter, it doesn't go into effect until next year in January, and it's only in place for the next 3 years thereafter. As a threshold requirement, we still need to have a quorum of the board in person from a single location within the local agency's territorial jurisdiction. So before we can even mess with, invoke AB 2449's new Brown Act alternative, we need to actually have a physical quorum of the board in person. There are two ways members can request for virtual attendance under this new law. One is a request for just cause, and the other is a request based on emergency circumstances. And so I'll go through each one of those with you in abbreviated detail because they're statutorily defined and limited in the number of times you may use them. So as a general matter, just cause is statutorily defined, and there's no board action required to allow for virtual attendance for just cause. Most of the just cause, as you'll see here, are traveling on official business, or you have some sort of caregiving needs or physical ailment that won't allow you to attend the meeting in person. Similarly, emergency circumstances under the new law is statutorily defined. Again, it's physical or medical emergency. The difference between just cause allow that member to participate based on this rationale of emergency circumstances. Now, if the board determines that the emergency circumstance is not indeed an emergency within the meaning of the statutorily defined purview, then that member cannot participate in the meeting as a trustee of the board. There are a few additional requirements. One is that if there's any, at the beginning of each meeting, if a member is participating remotely, they must disclose if there's any other adults with them in the room and describe their relationship to the trustee. And there's two more requirements, is that both your video and audio must be on at all times during the meeting. And so if your audio or video is off, you are not allowed to participate in any votes. And there's a limit on the total number of remote appearances you may have collectively between just cause and emergency circumstances for any calendar year. So let's talk about closed session. Before I go to that, are there any questions on the teleconferencing new rules?
I just want to make one comment. You can see from this new law that passed this year how strong the commitment is in the legislature to the open and public nature of our meetings. Because the only way that they were willing to pass an alternative to allow us to continue having any board members participate virtually is by creating this tremendous series of hurdles that have to be jumped through multiple times to make it as difficult as possible to actually comply with this new law. And it just underscores the strength of both the public employee unions and the media influence in the legislature, because those are classically the two bodies that really provide watchdog functions over the open and public nature of our meetings. And the legislature was not willing to simply allow us to continue doing what we're doing today, for example, even though it's completely open and public, but they were not willing to write this into the Brown Act without imposing these ridiculous hurdles, in my opinion, that make it nearly impossible to meet other than in person. And so stepping back from it is highly unlikely that we are going to suggest to you that we can clear these hurdles and we should use this new Rube Goldberg of a law to allow some of you to participate remotely. It's just is not workable. There have been some concerns about the Brown Act traditional teleconference rules because of the need to have to post. If people want to participate from their homes, for example, you got to post your home address and open the door and allow the public to come in if that's where you're going to be meeting from. There's a lot of sensitivity, obviously, and privacy issues that raises that board members elsewhere have raised. So it's awkward, but it really just shows you the legislature is not encouraging us to continue to do what we're doing now once the governor's declaration of emergency burns off in February. So it looks like, for the most part, we are going to have to be back in public meetings at a single location in the city of San Jose, the way we were before the COVID emergency happened.
Yeah, and that goes back to the purpose of the Brown Act, which is the American policy of open and accountable government. Some of the legislative history behind this new bill suggests that there is some concern that decision makers do not face their constituents face to face, and by having that ability to face the decision makers face to face is why this becomes so cumbersome and why the legislature made the law the way we did. So going to closed session, reverting back to Brown Act issues here, is that closed session is only permitted in limited circumstances. Again, this goes back to the key principle that public meetings should be done in open and public session with access to the public. So here are a few limited circumstances that the Brown Act allows us to go into closed session to discuss issues relating to the board's legislative decision-making. One is personnel issues, hiring, firing, complaints, evaluations of performance, labor negotiations. All of that may be done in closed session, with the exception that no final action on compensation can be taken in closed session. All of that needs to occur in open session, as we have done in the last few meetings relating to the CEO and CIO compensation review issues. Another thing that's permitted to go into closed session is legal issues. That includes pending or threatened litigation, any settlement, consideration of litigation, to sue. Another thing that may be included, that is included, is the purchase or sale of any specific investments. This also includes the hiring and firing of investment managers. That may also be discussed in closed session. Any real estate property negotiations may also be discussed in closed session. Anything that happens in closed session must be treated as confidential in terms of the discussion, and all votes in closed session must be done by roll call vote. Once a transaction or a litigation has settled or concluded, or an investment has consummated, there is a requirement to report out the action, and so certain actions would be reportable, and the members' votes would be disclosed at a later date, pending the conclusion of litigation or conclusion of an investment decision. So what's the difference between board action requiring a vote and board action requiring direction or invoking direction? A motion may be used by the board to take action on matters within the subject matter jurisdiction of the board that affects public interest. So a couple examples of that are setting contribution rates, making actuarial assumptions, adopting asset allocations, hiring investment managers. And so those are the types of board business that require an action by motion. In contrast, the board may use direction when it requests a ministerial act. So for example, a couple times our board has requested for ORS staff and provided direction for them to collect further information to bring back to the board for a decision at a future date. So voting and abstentions. Because the trustees have a fiduciary duty, part of your fiduciary duty is to administer the system, and voting is a key element to satisfy that duty. So you may abstain from voting if you truly have a reason for abstaining. For example, you were not at the prior meeting where the discussion was made and the action was deferred. You haven't had a chance to update or educate yourself to get up to speed. In situations like that, you may abstain from voting. Or if you have a bias or some other concern that really prevents you from rendering a fair vote. That's another reason why you may abstain. You, however, cannot abstain just to avoid controversy. Again, this goes back to your fiduciary duty to administer the system, and voting again is a key element of that. So you should use abstention sparingly and only for good reason. All votes must be reported, and as I mentioned earlier, during closed session and on teleconferencing, such as our Zoom meeting today, all votes must be done by roll call votes. So what are the penalties and remedies if the Brown Act is violated? Well, if there's a knowing violation of the Brown Act, it is a criminal misdemeanor. On the civil side, anyone can bring a civil suit to void the actions of the board based on a Brown Act violation. It could be a DA, it could be a member of the public. If it's a civil action brought against the board, that we have 30 to 90 days to cure the alleged violation before a suit may file. And if the Brown Act violation is established, the person who brought the Brown Act violation challenge will be entitled to attorney's fees and costs against the agency, but not against the individual board members. And insurance coverage for such recovery of costs and fees is questionable because yeah, insurance and coverage is questionable on that. Harvey, do you want to elaborate more on that?
No, we haven't tested this or had occasion to test this yet, whether your fiduciary insurance policy would cover violations of the Brown Act. A lot of it has to do with whether they're knowing or not. But you know, we'll try to keep you from having to ask your insurance companies whether it's covered. We'll just avoid situations that give rise to that question.
And circling back to my earlier comments, in addition to the Brown Act, there are also Public Records Act considerations. So again, anything that you put in writing is discoverable under the California Public Records Act. There are certain instances where material is considered non-disclosable under the Public Records Act, and those generally have to do with confidential information that may prejudice the public agency if disclosed. So for example, investment information that's proprietary is exempted from the California Public Records Act. And generally speaking, we shift the burden to the investment managers and consultants to make that delineation. So for example, a summary of our performance as a fund is not considered proprietary confidential information. However, if that same report contains information about where we should invest funds, that sort of information is proprietary and therefore should be deemed confidential. So if both informations are contained in the same report, the entire report cannot be deemed confidential. Only the portions of the report that are confidential should bear the legend confidential on it. Harvey, you look like you want to chime in.
So yeah, over time, our consultants, and I see Laura's still here. I don't think anybody from Newburgh or Berman is here, but this comes up a lot in reporting. And our consultants have gotten pretty savvy about it. For example, in the public reports that we make available and post with the agendas on our private equity programs, they don't go into the granular detail of the proprietary interests that are being held in the portfolio of our private equity and VC managers, because that would be proprietary trading information. The difficulties that we as counsel have had in the past in some situations is that a consultant will aggregate all of that, not only the investment level information, but also portfolio information into a single report, and some of which they want to declare, and rightly so, should be kept confidential, but a lot of it can't be kept confidential. So we've had a good success with the consulting community in educating them to know what to present to you for public posting and what should not be put in the public posted agenda material, because it is truly proprietary and confidential. So this is not, we have better control these days than we had 5 or 6 years ago over what can be made public and what can't be made public. So we're in pretty good shape on those things. Both Makita and Newburgh Berman are pretty savvy about that.
So as you'll see, the Brown Act is fairly complicated, particularly as it pertains to serial meetings. So when in doubt, please ask either Harvey or me for any guidance. So we have a couple hypotheticals that we want to run by you to test how well you were listening. Just kidding. But we have a couple hypotheticals we want to walk through to highlight some of the nuances of the law. So the first one here, Harvey, do you want to take it over?
Well, yeah, these are really to highlight some of the things we've been talking about and example situations that have even come up here before. I mean, let's take this first one, and it kind of gives you and we'll see what your reaction is to it, whether you think there's some Brown Act issues here. This first scenario is, there's a Calipers reception. Many of you have gone to Calipers conferences. The annual one is in March. And a lot of times you have a full forum of trustees attending Calipers conferences or CII or something like that. So in this hypothetical, during a reception, others are present, but 4 members of a board are talking together. And of course, please Roberta to know they're talking about giving their hardworking CEO a pay raise. Now that's 4 out of 9. Let's assume it's a 9-member board like we have. And they're talking, and the 4 of them agree that there should be increased compensation for the CEO. Later that evening, unbeknownst to the other members of the board, one of those trustees runs into another trustee and puts out the idea and says, don't you think it's a good idea if we give our CEO? And that trustee, that 5th trustee, says, yeah, I think it's a great idea. So they come to the next meeting, and on the agenda is compensation for the CEO. And somebody makes a motion, there's no discussion, the board votes to give the CEO a pay raise. At least 5 members of the board vote in favor of that. Anybody see a problem with this under the Brown Act?
That's hub and spoke, isn't it?
You want to call this a hub and spoke? That's interesting. Who's the hub in this one?
Well, the hub is the subquorum, which discussed it, and then they bring in the 5th. He spoke, and then you've got quorum.
Yeah, what's difficult about this situation is that there isn't a quorum initially, but the 4 members of the board who are talking about board business during a conference, so they're no longer protected from the Brown Act. They don't know that if one of their colleagues are going to talk to a 5th or a 6th or a 7th. Once you start the conversation, you can't control where it goes from there. And if they're passing along to each other their position on a matter that is on an upcoming agenda, in the colloquial phrase, the fix is in before it ever gets to a public meeting. And that's a real issue. Whether you call this a hub or spoke or a serial chain meeting, the impact is the same. A majority of the board has gotten together and traded ideas about the subject and deprives the public of any opportunity to observe and give any input. Why don't we go to the second hypothetical?
So we have a hand up from Trustee Ganapati.
Oh, I'm sorry, Sunita.
Hi, Harvey. So is the Brown Act violation because there wasn't a discussion at the board meeting, or because there was a discussion outside the board meeting?
The latter. There was a discussion outside the board meeting. The Brown Act can't force you to express ideas at a public meeting, but it can require you not to discuss ideas outside a public meeting.
Okay, so let me rephrase this. Suppose this hypothetical, in this hypothetical situation, at the next meeting, the board discusses whether to give the CEO a pay raise. Would that sort of cleanse the fact that some discussion happened outside?
No.
Okay, thanks.
Harvey, one question. This is, it's not clear in this description that there was a quorum involved in any of the numbers that added up, right? If there was no quorum, even after the one trustee spoke to another, this wouldn't be a violation, right? Because the Brown Act requires a quorum.
That's right. It wouldn't be a violation. If Howard, if you spoke with Sunita outside a board meeting about something, that in and of itself would not be a violation of the Brown Act, but it's sort of a pregnant violation of the Brown Act because you don't know, and Sunita wouldn't know, that you're not going to talk to a third, or she's not going to talk to a fourth.
Even
the
then,
fourth is going to talk to a fifth.
Yeah.
So only when it rises to the threshold of a quorum.
Right. So
Right.
assuming if, for example, in this situation, the board was comprised of 9 members, and the scenario here where 4 members discussed and then communicated to a fifth, that would violate the Brown Act.
Right.
However, because a quorum would have been reached. However, if the board was 16 members large, you're right, it would not result in a Brown Act violation.
Okay.
Yeah, it's just once you get started, discussions with board members outside a board meeting, it's hard to control. And so you just don't know when you're inadvertently going to have somebody's going to be end up putting you over the edge of the quorum amount.
Okay, got
And
it.
just for the record, we did this one time, I think it was about an election, Harvey, you remember, and 2 or 3 of us got together to have beers to talk about who would run next. That turned out, while not to be a violation of the Brown Act, a staggeringly bad idea. Fellow called us on it, like, what do you guys think? You're the Pope's counsel? So even if you don't violate the Brown Act, it's just bad decorum. I mean, it obviously depends on the importance of it. Yeah, next chairman, I think we screwed that one up. That was me and Vince and I forget who else. I've been a bad boy many times.
We had a client, a 9-member board, different client in a different jurisdiction, where 4 of the board members are appointed by the plan sponsor, kind of like here. And regularly, unbeknownst to me, before every board meeting, about a half hour, because they moved their board meetings, Sunita, from 8:30 to 9 o'clock. And at 8:30, the 4 appointed members of the board would get together in a conference room at the pension system and would talk through everything and get on the same page so that when they came to the board meeting, they were all in agreement. Now, it was 4 out of 9. So in theory, it didn't violate the Brown Act technically, but it violated every bit of the spirit of the Brown Act. And of course, you couldn't control if one of them went outside the room on the way to the board room and cornered another trustee who would be the 5th and say, hey, you know, we're all ready to go to 7.5% on the assumed rate of return. Will you join us? You can see the problem that creates. And that's what we're trying to avoid in these situations.
So let's go to the next hypothetical here. Harvey?
Well, that's the assumed rate of return. This is a hypothetical. So let's see how this one works. The board is going to consider the assumed rate of return or the discount rate at its next meeting. During the comment phase of the current meeting, you know how we have comments from board members, one board member announces her belief that we're in a new paradigm and she thinks that the rate should be raised to 7.5%. A few days later, 4 other board members text each other privately And they all agree to vote in favor of 7.5% assumed rate of return. So they come to the next board meeting. The vote is 5-4 in favor of raising the rate to 7.5%. What do you think about this one, Sunita? Brown Act violation?
First, I'll say the case sounded like me last month, but maybe I inspired this. But the rest of it definitely didn't happen. Yeah, absolutely, because it sounds like there was sort of lobbying behind the scenes, so to speak.
Yeah, already knowing that they had one person in their pocket at 7.5%, it then only took 4 more to get together to create a majority to go to 7. So it's that communication. Even though if you just took that middle paragraph, you took that as a snapshot and said 4 board members text each other and agree on 7.5%, that wouldn't in itself in a vacuum would not technically be a violation of the Brown Act. But given the first paragraph where they already heard the expression by another of their colleagues that she would go to 7.5, the fix was in. And again, you've deprived the public of the opportunity to hear and deliberate and participate in a key decision of the board. Why don't we quickly go to hypothetical 3? I think we have 4.
Yes.
So here's maybe what we would consider a hub and spoke situation. The CIO sends an article, public article to all the board members that praises the skill of an investment manager that they're considering for private equity mandate. And the CIO asks the other board members, let me know what you think after you read the article. 6 of the board members carefully reply to the CIO alone, not reply to all. And they say, yeah, we think this manager's terrific. We'll vote for the manager at the next meeting. At the meeting, the CIO announces that she's had favorable replies from 6 of the board members. The chair calls for a vote, no discussion, and the manager gets selected.
Prabhu would never do that.
I would never do
Why it's called a hypothetical.
That's why the example refers to a female CIO because it wasn't true.
Yeah.
I would say
what do you think, Roberta?
No, the fact that they got back to the CIO alone is not an issue, but the fact that the committee of the board then elected not to have an open discussion on the matter because of the CIO announcement is a problem.
Yeah. This may not technically be a violation of the Brown Act because the CIO did not communicate the positions of the other board members outside of the boardroom. The CIO communicated that for the first time to everybody during the board meeting. And maybe that's okay. Maybe this is a nod to efficiency. But it does seem to run very contrary to the purpose of the Brown Act, again, which is nothing about you. It's all about the public's access. Howard, do you have a comment?
Specifically here, the CIO is not on the board, and the Brown Act in particular refers to board members.
Well, but the CIO is here acting kind of as the hub.
Right.
In facilitating a quorum of the board members to come together. Say that's how this would work. So the CIO, while it is not a member of the board, so not counted towards a quorum, is facilitating a quorum, getting together and exchanging ideas.
Okay.
So, even if the CIO says it's a favorable reply, I'm not trying to be a lawyer to you.
That's okay. No, favorable meaning that, the CIO says we're considering this investment manager. I've had favorable replies to hire, favorable meaning we should hire this manager. So.
Yeah, no, but what I mean is, isn't that a leading response? That's all I mean.
Without identifying that he talked to six is what you're saying.
So if they just said, if she had said, I'd received replies from most of the board, that's different than saying you're trying
That
to
would-
create a consensus.
Yes, that would be different. Because here she's characterizing the content of the communication, not just the fact of the communication from board members. She's not just saying, I've heard from the board. She's identifying the positions of those 6 members of the board.
So you're still comfortable that it won't be it's unlikely to be a violation? I'm just wondering.
I could defend you on it.
Okay.
I think I could successfully defend you and get you off from a misdemeanor.
All right.
So Harvey,
Misdemeanor is minor. I can live with that.
But also look at it this way. Think of it from the perspective of if this had gone out on an RFP. Think of it as the perspective of a competing manager who comes to the board meeting expecting, to have an open discussion about, the competition. And turns out that there's no discussion and they pick the competitor manager without any further discussion.
except
What's
that's
the-
my, but hang on, Harvey, that's my question though. Couldn't the CIO call for this discussion in a closed session of the board meeting?
Oh, yes, yes. This
So it's
could
not
be-
necessarily going to be discussed in public.
Not at this time, but later it's going to be disclosed.
All
and the
right.
vote's going to be disclosed. But you're right, this could have been done in closed session for the selection of a manager. That's a good catch, Drew.
So, well, you were saying expediency, you mean expedience about sunshine. You meant expedience just, well, I don't want to take 20 minutes of a board meeting for something I could do via email.
Yeah, it's just, right. I mean, the CIO could say, geez, I'm just going to tell everybody that I got at least 6 of you. We don't even have to talk about this. Why take 15, 20 minutes during the board meeting when I've got the consensus of 6 out of 9, I'm ready to rock and roll. Again, expedient, but doesn't serve the purpose of giving the public access. And it also, to me, it also has a certain chilling effect on manager selection and may discourage competitive managers from even applying if they know that this is how it could go.
Okay, last hypothetical.
Last hypothetical. One at a time, the mayor calls into her office each of the public board members, instructs them to vote to raise the assumed rate of return to 7.5%, keep our contributions rates down, or if you don't vote for that, I'm going to replace you. Each of them individually pledges, yes, Madam Mayor, I will vote for 7.5% on the rate of return. One trustee of those public board members then texts the retiree member and says, listen, please vote for 7.5% or I'm going to be thrown off the board. And of course, the retired member readily agrees. So they come to the board meeting. There's no discussion. There's a motion, opt 7.5%. The board votes in favor of 7.5%. Sunita, what do you think about this one?
Well, I'm still answering. Okay.
I'm picking on you.
I think it's difficult because it just feels like it feels a bit like bullying. So my intuition, the spirit of the rule would say yes, it violates the Brown Act, but I don't know what the letter of the rule would say. I don't know.
Anybody want to venture a feeling on this one? How about Dick Santos? You're the retiree in this picture.
Yeah, there's a problem.
Definitely a violation, and if the mayor does that, you guys let us know.
Well, this is a real story, by the way. This took place in another jurisdiction. Roberto may know the story from our past.
Was that in Bell, California?
It was, yeah, not far from Bell, California.
Wow.
And this actually happened. It wasn't hypothetical. You know, sometimes chairs of supervisors or mayors have a lot of sway and authority over our board members. And but in this situation, the mayor is actually the hub, if you will, and the 4 public board members are spokes. They didn't come together in a meeting, but still there was a serial agreement among them that they're all going to go to 7.5%. Again, the fix was in outside of public session, and that's what we're trying to warn you about in these hypotheticals. So that's the caution.
But Harvey, if they'd had a discussion, coming back to that, at the board meeting, would that have changed things?
No, it wouldn't have. It wouldn't have. I put that in the hypothetical just to show you what could happen when agreement is reached outside of a board meeting. But they could have had a long and lengthy discussion at the board meeting, and this activity would still violate the Brown Act.
Hey, Harvey, supposing in that first paragraph that each of the public members said, you know, I don't know, or, you know, let me think about it, or I don't think this is right. Is there, and then there's a discussion, then everything's clean, right?
Probably so. Probably so.
We'll save the, except for the one trustee later, text the other trustee, the retired member. So taking that sentence out, then yes.
Okay, yeah. All right, because that's the way to avoid it, I suppose.
Because you don't need concurrence again for a Brown Act.
Yeah.
It just has to be the communications occurred amongst the forum of the board.
I mean, if the mayor tells the public board member, each public board member, you know, I'm speaking to each of the public board members, and I want you all to go to 7.5%. Then they know that that's been communicated to their colleagues. And so it should put them on edge, should warn them that they shouldn't have any further communications with themselves or to the retired member, for example, in this case.
Hey, Harvey, just to be clear, I guess I never really thought about this. If I don't do anything wrong, the mayor can't replace me, right? Next election they can. But right, I can't be recalled, can I, unless I do something wrong?
Well, that's correct. The way it was done in the place where this was a true story was that the mayor in that situation, before the mayor appointed anybody to a board or commission, got an unsigned, undated, got a signed but undated letter of resignation from each of the appointees.
Wow.
And when the board member was approached on the assumed rate of return, it happened to be the chair of the board in this situation, and that chair of the board balked, the mayor whipped out the signed but undated resignation letter, dated it, and tendered it to the mayor's office. And the chair was summarily resigned.
That's slimy as all get out. That's a good example. That's super slimy.
So there are a lot of ways, even if even if they don't have the legal authority, Drew, there are so many ways to make your life miserable, to get you off the board.
Harvey, isn't that being challenged in San Francisco?
This was not San Francisco.
No, I said, but isn't that being challenged? The resignation letter by the mayor appointing people? There was just an issue.
I'm not aware of that. Is that right, Dick?
That was just in San Francisco. Yeah, I'm not knocking the mayor. That's what you did.
Yeah.
gave resignation letters ahead of time.
Yep, that's kind of a real trick.
So, Harvey, if I could ask a question here. So,
please.
So you need a quorum, of the discussion, but does the outcome matter? Meaning that if 5 people on the board discuss it, but the outcome was it didn't go, in this particular case, they didn't agree to it eventually. Then is it not a violation?
No, you're right. It's the act of getting together, not the ultimate outcome, which is the violation.
So act of getting together to discuss a topic that's coming up in a board.
Correct. Exactly. Excellent point.
The big learning, at least for me, is the act of getting together is not just about getting together as a quorum. It could be the act of one-on-one communications that could spiral into a quorum.
Correct.
Yeah, that's a big learning.
Outside of the meeting. So again, this goes back to the public's access to the board and their deliberative processes. And so any sort of communications that can either spiral or otherwise outside of a public meeting, if it reaches the quorum threshold, it triggers the Brown Act.
So I guess the implications of this, if we really follow every little piece of it, which of course we as trustees are obligated to, how do we get into deeper discussions on specific topics? We have to meet more frequently. I'm not suggesting that, but I'm just asking.
Well, those discussions should occur in public session. So either you meet more frequently or you have you dedicate more time during the public meetings for those discussions to occur.
Or
it's
I guess we could get clarifications from Prabhu or Roberto.
Yeah, you can get direction. You can at a meeting get direction and collect all the information and then tee it up for a more deliberative meeting on that agenda item.
Thanks.
Okay, well, that's all we have for the Brown Act.
The law does not make it easy on you. And, it doesn't recognize the fact that because you only meet once a month, for example, maybe twice if you're on a committee, it doesn't give you an efficient way to approach those meetings. It wants the sausage to be made in public. And that's very difficult because those of you who sit on this board and devote your time and attention and energy to it, you're not getting paid very much to do that. And yet it requires enormous commitment of time. And so naturally you think about ways to make it more efficient. You do this in your life generally. How can I get the kids to school faster? How can I, and you're just used to doing that because you have limited resources. And the law just kind of works exactly in the opposite direction for you. It doesn't want you to be efficient. It doesn't want you to call up your colleagues and come to meetings already ready to go and prepared. It wants you to hash it all out in public. And it wants these meetings to go on very lengthy. So I can't say that it's the best way to make decisions, but it's a public policy issue that because this is a public agency, the public has a right to know and observe everything that you do and to participate in the attempt to influence your decision making. So that's why we try to bring this to you every year or so, just to kind of remind you that while it isn't efficient, it creates you making good decisions that the public can have trust in.
And I can speak personally, I'm pretty good with fiduciary duty. I still slip up. I slipped up a couple of months ago. It's a fine line, but I think, Harvey's always said that, and I'm sure Maytech agrees, maintaining trust is a huge strength for us. So doing this right, recusing ourselves when we have a conflict, and really even going beyond the letter of law to the spirit of law, I think is key. And we're a high function board. One of the reasons we're a high function board is because City trusts us, members trust us, we trust each other. It's a big damn deal.
Thanks very much.
Yeah, thanks, Harvey. Any more questions? Going once, going twice. All right. Hey, that's great. We're sort of through the work part. Well, I got something with the audit committee, but let's go ahead and do retirements. The first name, I love his name. Steve Biakanja, Fire Captain, Fire Department, effective November 11, 2022, 25.23 years of service with reciprocity. Rick Eli Cardenas II, police officer, police department, November 22nd, 2022, with 25.7 years service. John H. Carey, police sergeant, police department, effective November 29, 2022, 29.96 years service. Good for you, John. You almost made the big 3-0. Daniel Paul Gatla, police officer, police department, effective November 26, 2022, 31.65 years service. Give that guy a brass ring. Patrick Guire, police sergeant, police department, effective November 12, 2022, with 27.48 years of service with reciprocity. Alex Pons, fire engineer, fire department, effective November 12, 2022, 22.78 years service. And Honorio M. Silvera, police officer, police department, effective November 11, 2022, 25.87 years service. Do I have a motion to approve?
Santos, motion approved.
I have a second.
Second, Wilson.
A second, motion by Santos, second by Wilson's ground. Andrew.
Aye.
On.
Aye.
Sunita Ganapati.
Aye.
Howard.
Yes.
Ishvar.
Aye.
Dick.
Yes.
Franco.
Aye.
Dave.
Aye.
I'm Chair Lands. I vote aye. You guys want to say anything about or to these folks?
Oh, Santos, just congratulations and be safe and thank you for your service.
I echo the same things. Congratulations, Steve and Alex. Thank you for your service to the city and the department. Enjoy retirement.
Yeah, from Dave, I worked with all those guys. They're great guys, and good luck with your future endeavors. Enjoy retirement and live long.
Great. Now, we'll announce the death. We'll have a moment of silence. Notification of the death of Fred M. Abram, Assistant Police Chief, retired Jan 2, 1992, died September 19, 2022. Survivorship benefits to Connie Abrams' spouse. I apologize for laughing. This guy was a stud. This guy joined the force when I was 3 months old, and he didn't retire till my third child was walking. And he had a nice long retirement. Good for you, Fred. Condolences to your spouse. Good job, man. Notification of the death of Ronald E. Mosley, police officer, retired February 5th, 1998. Died July 9th, 2022. Survivorship benefits to Stephanie Mosley, spouse. Will now have a moment of silence. That's great. I don't know if you guys want to say anything about these two gentlemen.
Well, Dick Santos here, I'll just butt in. I knew Chief Abrams, and later on he worked for the Bay 101 Club in security when I was the fire captain over at Station 5, and we used to have, meetings once in a while because, and actually perform medical over there at the 101 Club. He was a great guy. I enjoyed him, and it's sad to hear, but he had a long life and did a great job. Thank you.
Thank you. Anything else?
Just condolences to their family.
Thanks, Franco. But good job, Abram, man. That guy served for over 35 years. Good job. Investment committee. Anything to report, Eshfar?
So we did have a meeting, I believe it was last week, discussed trading costs related to equity trading and FX trading. Yeah, that was it.
Great. Let me, for the record, go ahead. Let me, for the record, note we received and filed the minutes of August 23 and September 1st. Audit committee, over to you, Sunita. We've got some business here.
Yeah, we had a very solid meeting on October 20th. There was a joint meeting with Federated. I know there are a couple of agenda items, but I'm just going to highlight Human's report from internal audit on the was an A+ grade on accuracy of member contribution rates. It was a 99.9% accuracy and only a $15,000 impact on or sort of difference. So it was very small. And then, of course, Grant Thornton presented, I think, are they going to present, Roberto, or are you going to present the results of their annual audit? And again, an A+ for the team, because the financial audit was clean with no findings. So I don't know.
So, Sunita, they won't be presenting. They make the presentation to the joint audit committee and then allow the committee to then, as you are presenting this afternoon, share with the board their findings and overall the recommendation for approval by the committee. So they will not be presenting, but if there are any specific questions, staff is stand ready to address them.
Yeah, I think the committee approved that it be sent to the board for final approval. So.
Okay. And that will be items F and G. So both, not only the ACFR, but also their reports. And of course, the borderline here was that it was a clean audit on qualified opinion. And again, I can't say enough about the staff work. We had a very professional relationship with Grant Thornton. This was their last year, which means that staff is already working on a RFP that we're going to be issuing earlier in 2023 in time for the June 30th, 2023 audit of the financial statements. So again, kudos to staff. This is really an effort of the whole office, all the way from benefit staff, IT, obviously investments, which is a big part of it, and administration. But obviously most of the work falls on the accounting group, which is led by their manager Benji Wachoy. So again, congratulations to the whole team and for a great job. So keep up the good work. Thank you.
Thank you, Roberto. Drew, would you be proposing the action, or am I supposed to do that? I'm not sure.
I think it would be appropriate, Sunita.
No, all right, let's to make sure we don't miss anything. A was your oral update. We did that. B, we received minutes August 18. C, we received minutes September 1st. We looked at the update D on the city auditor's recommendation. E, we have the report on the member contribution rates. And then F and G are going to require action. F is the auditor's report. And you both said it was a great report, and we've got it there. So the floor is open for motion to approve Grant Thornton's audit report. You want to make that motion, Sunita?
Motion to, oh, sorry.
Go ahead, Howard. I'll second. Go ahead.
Motion to approve, Trustee Lee.
And you second?
I'll second the motion.
By Lee, a second by Sunita. Let's go around. Andrew?
Aye.
David Kwan?
Aye.
Sunita?
Aye.
Howard? Howard?
Yeah. Yes.
Good, that's an aye. Neshwar?
Aye.
Dick?
Yes.
Franco?
Aye.
Dave?
Aye.
I'm Chair Lanza. I vote aye as well. And the last item is for the action, the cap grants manual financial reports. The floor is open for a motion to approve that.
I have a motion from Sunita.
Motion from Sunita. I'm Lanza. I'll second. Andrew?
Aye.
Kwan?
Aye.
Rita?
Aye.
Bird?
Yes.
Bar?
Aye.
Dick?
Yeah.
Franco? Franco? Maybe?
Aye.
Oh, good. Dave Wilson?
Aye.
Chair Lanza, I vote aye as well. Good job, Sunita. Thanks so much. Governance, anything to report?
Mr. Chair,
Franco?
Mr. Chair, before
Yes,
we go
go
to governance, if I can, I would like to take this opportunity to say something about item D, updating the city auditor recommendation. Because it was actually raised at the audit committee. This is actually the audit by the city auditor on the Office of Retirement Services that was actually requested by the mayor. And the reason is still showing up every committee and board meeting over the last year and a half is because when there are recommendations that are outstanding, we continue providing information. One of the recommendations that is still outstanding has to do with the city's position and the city auditor's recommendation that the investment expenses are included in the budget presented, not only to the boards for approval, but to the city council. And so I just wanted to, especially for those of you who are new to the board and are not part of the audit committee, your boards, both of them receive a legal analysis from your general counsel on this issue, which actually explain, and Harvey, if I'm mistaken, please feel free to correct me, that investment expenses basically in California law are to be deducted from the earnings of the plan and are not part of the administrative budget. And obviously the city feel differently about that, and so does the city auditor. So we have not been able to actually meet the actual recommendation in the audit. That said, I think that the board have taken steps, even though the city auditor has not agreed to amend the recommendation, have taken steps so that in spirit of that recommendation to provide as much transparency as possible in relation to the investment expenses and the annual budget. And one of them actually Prabhu spoke about earlier, which he will be going to the city council next week and present the annual report on investment expenses. That's one of them, which is actually a very comprehensive report that only a handful of systems, not only in California, but actually in the whole nation actually prepare. But also we go, we actually, as you've seen in the presentations of the annual budget, provide you and the city council with potential and estimates of investment expenses, of course, based on two thoughts, which is the first one is based on the current asset allocation, and second, assuming that we will return the actual assumed rate of return, which we know that is not usually the case. So we do have taken steps to provide some transparency in the process and some information for the city council, but remains that we're not really actually adding or including those investment expenses as part of the annual administrative budget, and as such, this recommendation is still open. So I just wanted you all to know that. I honestly do not see that particular recommendation coming to some kind of agreement anytime soon, and I suspect that council's opinion would not change of you that provided to your boards, and therefore the board's position again will not change on this issue. But I just wanted to make that comment because number one, we don't speak about it often, and two, it was raised at the audit committee, and I wanted to make sure that we took this opportunity to raise that issue again. Thank you.
You know, we talked about this. I think we should just reject it because we're never going to do it. It's a screwy request.
Yeah, it seems like it's a stalemate. Certainly, we talked about it at the audit committee meeting, and it doesn't look like they're going to budge.
Yeah, it sounds like you're handling exactly right, but look, it's not what everybody else says, so we're not going to do it. But here's the number. You know, we're accounting for it, but we're not going to. We're telling you what the number is, but you know, we're not. We run this in private companies all the time. CFOs put the wrong number in the wrong box, and we're like, no, and they say, well, it's my job, and we're like, no, your job is to do what everybody else does.
I mean, I think that we could. The one argument perhaps is that to say that if you give a budget, we may not be able to produce as much alpha, because the whole purpose of the board is to be able to have the flexibility to
Yeah.
do the strategic asset allocation in a way that alpha is generated and the fees are spent well. So I
Yeah.
don't, it's too complicated a request.
Yeah, hey,
Well,
next meeting, soon, once you take that up, Roberto, I'd be very happy talking to the council of the mayor saying, you know what, guys, we are not going to do something special just because of you. We're going to do what everybody else does.
yeah, this is actually the city auditor. So I will make a point, Benji, if you're listening, that we had to reach out to the city auditor on their defense, on their behalf. I did provide them with access to our different peers across the state. They reach out to all the different plans. I'm assuming not all of them in California. And they found 3 jurisdictions that actually have some information on the investment, actually, I believe, provides some investment expenses in the annual budget. To be quite honest, I don't remember the specifics, but suffice to say that in my experience of 25 years working in California, I agree with counsel, and of course, he is your attorney general counsel, that investments are to be deducted from investment earnings. They're not part of the administrative budget. But second, even if we wanted to somehow disregard your counsel's opinion and try to include it, I have always made the point, what do you do? Say, for example, last year, when we returned close to 30%, and the cost is actually going to be much higher than anticipated because we are actually returning about 4 or 3 times more than your assumed rate of return. You go back to the board and ask them for millions of dollars so that you can make and pay your invoices. It just doesn't make sense. So I agree with you. I will make a point to reach out to the city auditor and I'll try to report back to the audit committee next time. Thank you, Mr. Chair.
Great. Thanks, Sunita. Thanks, Ruto. Governance, anything to report, Franco?
Nothing new.
Great. Let me know, we received and filed the minutes of September 1st. Disability Committee, Dick, anything to report?
No, we'll be having a meeting at 10 o'clock on November 7th.
Great. We received and filed minutes from September 1 and September 6. JPC, is that you, Andrew, or Eshrar? I forget.
I think it's Eshrar, but I have no problem talking about it.
Yeah.
Yeah, go ahead, Andrew.
Anything to report?
I'll just reiterate. There's the committee is taking up 3 issues or 3 items right now. All big plate items. 1, CEO compensation. 2, the incentive program trying to implement, and then 3, we're reviewing the MPP process that we implemented with the help of Cortex last year, and just reviewing how that process went this year and any changes that might be needed. And that's about it. We got a meeting next week.
Great, thanks, Andrew. I can say we got an extremely high function JPC, both on our side and the other side. We got Eshrar, me, and Andrew. We are grabbing dirt with our wheels. We're going to get a lot done next year. Let me note, we receive and file September 9, September 15 minutes. Any public comments? Anybody want to jump in before we go to AB 463?
Sure, I got one last comment to make.
Yeah, sure.
Roberto made a comment during his CEO update. I wanted to thank, so last week, Local 230, the fire union, hosted a retirement workshop. I want to thank Sandra Castellano, the benefits manager, for allowing Melanie and Han to attend. They were a big part of that morning and the presentation. It was well received. We had about 40 people that fire members that participated in the 3-hour session, and it was a success. So I want to thank staff for everything you guys have done. You guys made everything possible. Thank you.
Great, thanks. If no more, over to you, Maytak, for the AB show.
You have to adjourn the meeting.
This meeting is adjourned. Next thing you hear, my knuckles rapping on the desk. Over to you, Maytak.